Okay. Those who have joined recently, like Abhisa, Srasti, or anybody in last 15, 20 days, those who have joined, if they are targeting to give exam in September, I don't know exact date. I think the September date, exam date is 10th or 11th September. 2 months or more, 2 months are there. You need to try that. You need to cover up with the recordings, whatever we have studied. One by one, you will follow the system which I say always in the class. When you do the recording, don't see any material secondary. First of all, do the recordings. In the recording in the first class, I say which material, where, what you should be seeing, what are the areas where we need to study. I take to the ACCA website, I show everything in 1.5 hour to 2 hour. Then we start discussing. So suppose you have done the recording of first class. Generally in the first class, I don't able to teach anything. It's just that I say format of as per IFRS, PL account, balance sheet, and those things. Then from the next class, I start a topic. I don't remember exactly, but I start a topic. So you will be doing the class recording. Once the recording is done, don't skip any part of the recording. Maybe one time when you have done, second time you can skip, but you should be doing full recording without breaks. So full recording you will be doing whatever is taught in the class. You should be doing that thing on your own. Maybe a problem, maybe a discussion, or whatever taught in the class you should be doing on your own. You have seen the recording, you have understood the concept, should be done separately by the student the same thing. Whether you are doing the live class, then also the same story. Once the class is over, do the same thing again on your own. Don't do anything new in the chapter. When you do the same thing, you will realize that you have understood something, but still there are some problems, some areas which you understood, but you didn't get the clarity 100%. Or maybe at that time you understood, but when you were doing on your own, you were not able to do it. Make your notes, go through with the chapter once, and then whatever the questions which we have not solved in the class, maybe I have discussed, maybe I have not discussed that question, solve that on your own. Don't see the solution. Do it wrong, not an issue, but do the solution on your own. Once you did the solution, then see the solutions which is given by the institute. Most of the times you will find that there are some areas which I have understood, but not that clarity there. So you will be making your notes. And in the questions where some sealing mistake you were doing, not a problem. You will try that. You will not be doing the sealing mistake. And you will be making your full notes. While making your notes, whether you are referring my notes, Kaplan, BPP, or whatever book you have, or maybe your old books of CAs or anything. Book is a book. You have to have your own notes ready. That in this chapter I have studied this, I have understood this. And in the chapter, if there are 20 problems, not that next time when you revise, you want to revise all the 20 problems. There may be 3, 4, 5 problems which you want to revise. Copy paste those problems in your notes only. Take a screenshot, copy the question. If there is anything which you need to remember, write that. So later on when you revise, you will be referring only your notes. No, not single notes. Anybody else notes is not required. Because our notes is the only notes which should be used for revision. That way, we should have a target that in a week, say Monday to Sunday, I will be doing 2 or 3 recordings, and then I will be studying on my own. So you can say that in 2 months, I am taking 2 months target, 60 days. If you are doing 3 recordings in a week or 2 recordings in a week, then also the number of recordings are not that much that it require more than 2 months. And you will study on your own on the basis of guidelines. Don't refer the notes first. First do the recordings. First do the live class, whichever we are having. Then refer the notes or anything. You will be able to understand faster and your knowledge process will be better. And always whenever you are studying something, make your own notes. In a computer screen only, because I don't know. Recently, around 3-4 days back, Institute again connected and they said that can we have the exam for IFRS also on computer based in September 11? I don't know. It's just that I'm saying, you can say insider information. Institute called, maybe other learning partners also, and they said that whether the IFRS exam can be computer based also in September. Because of you all know that the CA exams, CWA exams got cancelled. They don't want that the exam should be cancelled or the problem arises. I said that, sir, mostly IFRS students are not ready, which I got with a discussion in the class, or maybe not in the class, in the messages and call I have received, that IFRS student generally very afraid of, you can see, computer based exam. They should not be, but that's the story, because all the IFRS students are working. So when they are working on computers only. They are working on mails, they are working on Word, Excel, that only. So there is no problem that if the exam will be on computer basis, but I communicated them, generally the IFRS students are not ready. And as far as ACCA professional level exams, they are up till now pen and paper based. In some of the countries, computer based already started. I said that maybe as we are exam students are ready, they can give. But I just informed them that they should be informed in advance. Not that we should be communicating them 5 days, 10 days before the exam. A student has taken the money, institute has taken the feedback. What they will be doing, I don't know. But there are very high probability that maybe, I'm just saying from my own angle, there is no communication to me by institute or not to you. They will communicate to me and to you, everybody. Maybe the September exam of IFRS will also be in computer based. But all the exams which will be on computer based, they will be given option to the students, which I have always forced them, or you can say communicated in my language, that it is advisable that the students should be given option. If the exam is in exam center, the student will be taking the risk, will be going in the exam center. That's a student call. If the student don't want to go in the exam center, they want to give exam by sitting in home, they don't have to travel anywhere, they can opt for that option also. So both the options should be given to students. It's their call what they want to do. Now what the institute will do, I don't know. But they will communicate within maximum 15th July to everybody, everything. So we need to wait for a call from the institute, mail from the institute, I mean to say, to you, to me, that what they have decided. They had a big discussion happened at global level on Friday. But obviously Saturday, Sunday is holiday, they will communicate. Most probably, according to me, since institute is fully ready with the computer based exams in all format. They are already taking exams in computer based skill level. Professional level they are taking in some countries. So they are already ready with the computer based exams. It's just that whether that can be happened on remote basis in the student's house, that's the question. Because when you will be giving exam from home, somebody will be invigilating you for the 3 hours. Suppose I am giving exam, you are invigilating, you are seeing what I am teaching and all that. I am fully in front of you. Similarly, when you will be giving exam from home, there is somebody from any part of the world will be looking at you from the camera entire 3 hours, that you are not taking any unfair means for the exams. That requires some additional resources, arrangement that the institute need to think. But as per my sixth sense, you can say, they will be bringing this option that the student can give exam on pen and paper, the student can give exam on computer based. That will be happening only for professional level and IFRS, not for skill level. Skill level already exams since 2016 computer based only. So we need to wait for some time. You can say maximum 7-10 days. You all and we will get information from the institute, everything, what they have decided for September. The exams will be there. That's guarantee. The exams will be there. That's guarantee. But what format? That is not yet open. That we need to wait, me and you both, for 5-7 days. We will get it. I think this week only, as per my knowledge. Now, whether the exam in the exam center or whether the exam in home, the difference is only one. In the center, maybe it is copy pen based, and in home it will be maybe remote based, computer based. Obviously, you cannot write on a copy in home. According to me, principally, as I think, I am not a very specialist in typing and all that. Maybe weak than whatever you all are. But I don't think that if I will be giving exam on pen and paper based, it will be very easy. According to me, if the exam is computer based, it is easier. There is no question of handwriting and all that. Just that the hiccups, the mentality, we are not ready to accept the changes. That's the only thing. Otherwise, there is no issue. So if I will say that, Abhisa, please click your audio. So what I am saying that according to me, pen and paper based exam is difficult to give and computer based exam is easy to crack. As far as if somebody say that, sir, my English is not good, I do grammatical mistake, I do spelling mistake, institute is saying all over the world, English is a language. I know Hindi, somebody know French, somebody know. That doesn't mean that if I don't know English, that means I am bad. Language is a language. So if in your writing sentences there is English mistake, there is spelling mistake, there is grammatical mistake, there is no deduction of marks, not in any exam. And it will never happen because it's just a language. If whatever you are writing, I am not able to understand what you want to say, I will not give you marks. Not because your spelling is a problem, not because your grammar is a problem. That's not an issue. When you are writing something and I am not able to understand what you are writing, I cannot give you marks. That happens in a copy pen based exam also. And the second thing, according to me, the student afraid that I have never given exam like this. For that reason, I say from the first class only, study on screen. Don't take printout. Study on screen, make your notes on a screen, everything on screen only. Like we are working in our practical world, the same way the study should be done. I to say so many times like that. If you have taken printout, throw the printout from window. Don't use printout. So that is your choice. Ultimately, the IFRS exam from December computer based, professional level exam from March 2021 computer based. That's the already fixed. Just the two terms are left, September and December. What the institute will call for that term, I mean to say for professional level, September and December. As far as India is concerned, and for IFRS only September. They will take a call, they will communicate. According to me, the best on the part of the institute give the option, pen and paper and computer based. But I am not the authority. I am just, you can say, an advisor to the institute. I have advised my own peace of mind. Now what institute will take a call, that we need to wait. The last thing, like Arvinda or sometimes some of the students says that, sir, do we have Kaplan or BPP pocket notes? Pocket notes means what? Just as an example, this is at the end of the chapter, there is a summary that in this chapter what they have included. Okay. That is, there is financial statement ratio, cash flow, APM based ratios, there is non-financial measures, then there is integrated reporting that they are saying. In a pocket notes, this thing is slightly elaborated. Ratios. Suppose in the chapter, the ratios are written in 3-4 categories. Profitability ratio, then you can say liquidity ratios, long-term solvency, investor ratios. They have given 4. Now here they have not written the ratio name, gross profit margin, net profit margin. In a pocket notes, they have written gross profit, net profit. No explanation, just the formula they have written. On a cash flow basis, the cash flow is operating activity, investment activity, financing activity. What is operating activity? They have written in a paragraph. What is financing activity? They have written in a paragraph. In operating activity, maybe they have written that you will start with this plus minus, you will do this. In a pocket notes, like in a study material, they are giving examples, they are giving illustrations, they are giving test your understanding. In a pocket notes, they are not writing that. They are only writing, you can say, broader headings. What is included in a chapter? According to me, if that is not costly, that is costing, I think in Indian currency, 500 or 600 rupees for a subject. But I had purchased that in the past also. And recently, you can say in the current year also, in January 2020, I purchased for taxation subjects, in the skill level taxation subjects. But believe me, when I'm studying, even I'm saying about me, When I'm studying, I'm not getting the feeling with the pocket notes. I'm getting the feeling from the study material only. When I read the entire concept, when I read the illustrations, when I do the questions, then only my feeling develops. And when I'm doing a chapter, and if I'm not making my notes, my pocket notes will not help me. I have to make my own notes where I am feeling problem. It's not as per the pocket notes. It's the summary of a chapter, slightly greater level than what is given in the end of the chapter. Generally, the institute says that that will be very handy or helpful. Suppose your exam is after 2-3 days. Then for 2-3 days, you will not be able to study entire thing. Not possible also. You will be revising the stuff through pocket notes. According to me, we will be revising through our own notes. Own notes in the sense, not mine, not Kaplan. Whatever we have studied, we have made our notes. We will be revising at the time of exam through my own notes. I will be able to understand faster. That is written by me. That is my peace of mind. That is my areas where I am facing problem. That is my areas where I am not facing problem. That is different for every student. That will be used not only for exam. That will be used in your practical life, whole life, wherever you are, even after 20 years. Because something which you have written, that will be in your brain. I can say that suppose I studied something around when I was a student at CA. The notes are still there with me. Many times I open that, I understand them very well. You can correlate that with whatever study you have done in the past. If you have done something in write-up, then in that case, that's your study. You will never forget. So not because of the cost, I found that they are not so useful. So I purchased it 2-3 times in the January also for tax paper, but I was not satisfied. For that reason, I stopped purchasing that. The second thing, we can say that we are using in the class Kaplan exam kit or Kaplan study text. Somebody can say that, sir, BPP is better because it's a personal opinion. According to me, which is given by the institute, that whether you purchase Kaplan, whether you purchase BPP, those who have written the Kaplan books, those who have written BPP books, there is a meeting at least 1 time or 2 times in a year with the entire world publishers. They come on the forum, they say that 80% of the questions they have taken from institute website only, whatever we can get freely. On institute website, when we go, we are getting the questions of different terms. Some are fully given, some are partially given. The whole world, whether it's a Kaplan or BPP or anybody, gets those questions only from the institute. Earlier, when I didn't met with them, then at that time, I thought that they are getting from the institute entire question paper. But it was categorically said by the ACCA institute, by the Kaplan, by the BPP, by all the publishers, that they don't get anything extra which is freely available on the ACCA website. On the ACCA website, some terms question are fully given 100 marks. Some term questions are partially given, not fully given. They all in the world, whether it's a student, whether me or whether Kaplan BP, they get that only. And if you focus on their exam kit, 80% are from there only. Obviously, they have changed some figures. They have changed some names, or maybe somewhere they have incorporated 1 or 2 extra adjustment, deleted some adjustment, that they have done. But the questions basically are from the institute website only. So according to me personally, if you ask, the exam kit is also not required. But why we are using exam kit? Reason being that in the exam ACCA website, the questions are not written from which chapter. They are given in totality from the entire syllabus. So the problem arises that when I am studying a chapter, I need to do huge research in which chapter that question came. It is better that in place of doing that research, we get this ready. For that reason, we are purchasing, you can say, using exam kit. Because that's the rule, we have to use exam kit. If we don't use, then in that case, chapter-wise questions practice we will not be able to do. But ultimately, when the exam will come, say on September 11th, 7 to 11 exam is there. For the last 10-15 days, I have to do question from exam paper only, not from kit. I will be getting a question from consolidation, from EPS, from employee benefits, from this, from financial instrument. So whether I am able to do that, how much time I am taking, can I recollect the entire thing? The last 10 days would be given for that only. So we will be doing last 10 days question, not from Kaplan, fully from, you can say, institute website only, so that we can understand that one by one when topics are coming, Can we recollect? Can we remember? Can we handle the issue? That's the we have everybody. Whether you are a normal average student, whether you are an above average going to score 80, 90. But you have to do the papers from the institute website only at last 10, 15 days. Then only the probability of passing will come. The last thing, sometimes you can say that we are using a material of 2018-19, 1 year back. Sometimes 17-18 also. On the institute website, every year they are saying that the syllabus is from September 2020 to June 21. For IFRS, whatever the syllabus that is applicable for December and not a problem. For IFRS, there is some guidelines given by the institute always that for December and June exam, the same course is available. Obviously, if there is new IFRS, something comes, they incorporate in June exam. But generally, they release the syllabus and everything for IFRS. Say for next two exams, it is already released that December 20 and June 21 exam will be this syllabus. If we are talking about a regulatory paper, which changes happen, say IFRS, IAS, law, tax. These are the three things where the regulatory changes will be happening on gradual basis. Gradual means not every day, but some changes will be happening. But the other subjects, whether it's auditing, whether it's finance, whether it's costing, whether it's management accounting, any subject, the way the changes are, there is no change as such. Obviously, institute will say that in this chapter, we have included this new heading. In this chapter, we have excluded this heading. In this chapter, we have included IT heading. There is no addition or deletion. Definitely, they will change some part of the things, some broader headings which are given by the institute 1 year in advance. Whether you or me, if you are not going through that, I should be going through that. What are the guidelines institute has given? What are the new things they are adding? Each those things we are teaching in the class already that need to be covered. If that not teaching, then that need to be covered in the class. That's my responsibility. I should be doing that. That I will cover. But for that, if I will purchase a new material, I don't think so it is advisable because the new material is very costly. And as I always say that whatever we are giving is our study resources, whatever we have. I don't feel that I'm giving Kaplan or BPP or anything. I'm giving my resources. The most important thing is the time which we are giving for teaching. Because the most important thing is the explanation and the videos and the live classes. They are supported by materials which are treated as supported by Saraf Academy. We are not selling materials. We are not the seller of materials. Kaplan, because you can purchase Kaplan BPP material from the market. Then what is my use? If I will be giving that, then what is the purpose of the classes? So we are saying that we are teaching hardcore teaching, and generally whatever materials I am giving, according to me, my understanding, it is more than enough for whatever marks you want to score. But still, if you think that they are not sufficient, they are unlimited, they are limited, they are not covering this and that, you can purchase any material. There is no problem. But believe me, the student has scored world rank 1 in SBR also. In IFRS also, a student has scored greater than 90 by referring the materials which I have given, by referring the classes which I have given. I'm not talking about only passing. Generally in SBR, the pass percentage is very good regularly. It's around 50, 52, 48, 50%. So generally the student in SBR exam don't fail. It's my 5 to 6 years experience. If 10 students are giving exam, 8 to 9 passed. IFRS, students generally don't fail. Even though they are not studying that much, but in the last 10, 15 days, they study very well, cover the questions. Maybe they are not studying in the direction which I am saying, but they clear. So this is not an exam which is difficult. The pass percentage is very good. The problems are there in the optional paper. Whether you go for AFM, whether you go for APM, whether you go for advanced auditing, whether you go for advanced taxation. These 4 papers are problem. The pass percentage is not very bad. 35% is still there. But you understand all those students who are giving exam, they are having a level. They are not that anything who don't have understanding or anything. Out of the good chunk, only 35% are passing. So anybody who is not preparing at the proper level, they can't pass APM, AFM, AAA and ATX. But the SBL and SBR exam are having good results. Generally, the student who says that, sir, I will not pass, after giving the exam, you can see their face, they are not looking good, but they passed. It's not that the institute is passing them like anything. Please understand that if your balance sheet does not tally, that doesn't mean that you will fail. If your cash flow does not tally, that doesn't mean that you will fail. Whatever adjustments you have done, that is fixed marking is there by the institute. On the basis of the correct adjustment, you are getting the marks. So you are able to pass. But all the elective papers are very advanced level. If you elect AFM, that means you are the best person in finance. It's not a paper. They are saying that you are a specialist in that area. But in SBR and SBL, even though the paper is difficult, but they are not thinking you that you are the specialist. When you are electing something, auditing, that means you are best in auditing. That's the reason. So they cannot accept anything in which your knowledge is not perfect. So you can understand that it is difficult to pass the elective papers, but the compulsory paper are easy to crack. Somebody will fail if he don't study. If you study, there is no chance that you will fail in the SBR or IFRS exam. If we study properly, we can score very good marks. Very good marks. And we can understand that generally in ACCA or IFRS, we are studying one subject only. It's not like Indian courses, audit, tax, law, costing, finance, everything you are studying. So you are not getting time to study another subject. One subject you focus, others goes out. And at the time of exam, you are puzzled. 6, 7, 8 subject you are studying. That problem is not there here. It's not that the syllabus is less. The same syllabus, maybe more. But you are studying only one subject. Accounts, for the last 4 months we are studying. Still further 2 months we are going to study accounts only. So one subject we are studying 6 months. How can't we be perfect in that subject? How? Because the purpose is not to pass the exam. The purpose is to get the feeling that everything in the syllabus I should be knowing with conformity. So that wherever I will be going, wherever I will be working, I will be able to handle the issue on my own. Not related with the exam. Exam se kya hai? What? Exam is just a pass and fail. The most important thing, can I handle the issues in my life practically on my own? Can I become in a big company having turnover in $1,000 million? Can I become the accounts controller? Can I become that by doing the SBR or IFRS study? That's the purpose. The purpose is not just whatever questions is there in the exams or in the book we will be doing. Think logically whenever you are studying that, what is your purpose? When you decide your purpose, your study will change. So exam is not difficult. Whatever resources according to me is best required, I have said. If anybody thinks that those resources are insufficient, when you give exam, you will realize. But presently, I can say that you can purchase on your own. It will not cost you very much. But according to me, not required. That is my advice. We are sharing our resources. Whether anything included or not, that's not the question. The most important thing is the classes. When I taught the same thing in the previous batch, why I am teaching again? Why I will teach again after 5, 6 months? Already we are teaching. Always to give a new feeling. Live class. Then you can see questions, doubts. A student can ask. Every time continuously the batches are going on. Even though there is no change in the syllabus. But you all understand that if I will teach 13 subjects in a quarter, when I will teach? Because most of the students are working. Morning, evening, there is only 2 times possible. At the same time, if I will teach, then also I will not be getting students for 13 subjects. A student cannot give exam in ACCA group basis 5, 6. They will not be trying. So that also is a problem. At the same time, there are some other responsibilities also. So we regularly go on teaching one by one subject live. One term this, another term this. Go on reshuffling. A student go on joining new one. Somebody joined here. Somebody will join after 2 months. Whatever I will be teaching live, that student will be doing that live. He don't want to do recording of SBR. Don't do. Again, I will teach after 5, 6 months. Do the live class of SBR. If somebody is doing the class now, not give an exam, you can again do after 6 months live class. I don't have a problem. But you all understand that in the first class, when I start a live batch, Around 20-25 student joins. And after 2 to 3 classes, 4 or 5 left. It's not that others are bad, but they don't able to manage the time even though it is beyond office hour. That's the problem. Because everybody is working very busy in life. For that reason, they are not able to do the live classes. They are doing the recordings. Not that everybody is not studying. In every course, 50% of a student study, they pass the exam, they clear the course, they get the degree. 50% leave the course. And that is happening for the last 30 years. In any course which I teach, 50% of students are good. 50% don't study. Not that they are bad, they are not getting time, they don't enjoy study, for that reason they leave. But what can we do? We can do again and again live teaching, again and again forcing them that study, that we can do. That we are doing, that I will always do till my death. But if you think that this material and all that is not there, according to me, that is not required. If you are thinking you require, you buy, you will analyze, you will understand. You can buy one piece, you will get that was not useful. Because if anything useful, I will be giving. Believe me. Okay. These were general discussion relating to exams and all that. Exam will be there. And we are registering all the students for IFRS today and tomorrow, everybody. Those who have said they will not give exam, it's other thing. But those who have said they will give exam, we cannot wait for 14th July to take action. We are registering everybody. We were supposed to register yesterday only. But because of some issues, we are going to register on Monday, Tuesday, Wednesday, maximum 3 days. Everybody who are doing the IFRS and who are going to give exam in September. Once we register, you will receive a mail from my team that you have been registered in IFRS exam. Now you can book your center. So your center where you want to give exam whole over world, you will be selecting your own. We are not selecting. We will register you. We will create your user ID and password. You will use your user ID and password. Go into the institute website and you will select the center where you want to give exam. Okay. So IFRS registration we will be doing in coming 3 days from today. Anything, any question before proceeding? Because these are very important always, because in Indian course, these things does not arise. But in international course, how to study, what to study and all that, exams, everything, I am the only person who can help you. For that reason, I need to communicate. So we are proceeding. The chapter is analysis and interpretations of financial statement. You all will agree with me. If we have an experience of 5, 6, 10 years, generally, in the practical world, we are not going to prepare PL account, balance sheet, cash flow, statement of changes in equity. We are not going to prepare. Our junior will prepare. Our subordinate will prepare because they are at that level where we were earlier, maybe 3, 4 years back. I have gone to next level. So when I am at the next level, my job is this only in the organization. Analysis and interpretation of financial statement. I am not the person who will be preparing the financials. I am the person who will be analyzing the financials. Analyzing involves 2 things. One is somebody has prepared PL account, balance sheet, maybe in an accounting package. I'm not questioning that. Ledger journal prepared in a register, in an accounting package. But that junior must have done some mistakes. So you will go in the trial balance, you will look in the financials, you will see that where he has done mistake, you will rectify. You are able to rectify because you have the analysis and interpretation skill. The second thing, maybe that domain you are not there. So you don't have to rectify. Somebody else will do. But you are in the domain comparing the financials of current year with the previous years, our financials with the other organization, competitors in the same industry. You are doing a comparative analysis. And you are helping your organization where we need to improve, where we are not performing well, where we are performing well. So you need to do an analysis, comparison of your previous year data of your competitors. The third thing I can say that suppose we are working in a mutual fund or a finance company, banks, financial institutions, they regularly invest in different types of corporates. That's the job. Or maybe you are investing for your own self, you have money, you want to invest in a corporate. How you will analyze that whether you should invest in that company, or you will advise to mutual fund company or any finance company that they should invest in this company. There are two things. One is technical, charts, how the prices are moving and all that, which is not we are studying here. And the second is fundamentals. The fundamental means financial statement, PL account, balance sheet, notes to accounts, cash flow statement, all these things. You will analyze them. Again, at the same money, when you are doing that, you are analyzing from the past, you are analyzing from the competitor, industry, then only you can comment that whether the investment should be done or not, why, what is our objective, that you can advise. If I will say that, that also is not there. If I'm in a company working in the cost department, or I'm working in a company in purchase department, sales department, whatever, when the company is purchasing goods, we need to analyze from whom we should be purchasing. You can see the selection of suppliers, the selection of customers, whether the credit should be awarded to the customers or not. If we are working in a banks or financial institution, there is a client asking for loan, whether the bank should be giving loan to that client or not. How all these decisions we will be taking? By looking at the financials of the client, of the suppliers, of the customers, anybody. That means financial statement analysis and interpretations is a very most important job for a person who say that I have very sound knowledge of accounting. If we are saying that we are a common man, then we will be preparing financials only. We will never be analyzing. But if we say that we are top level, or we can go into top level, then in that case, analysis and interpretation is the thing which we should be knowing very well. This analysis and interpretation does not involve a particular IAS, IFRS, does not involve a particular case. Everything. Whatever we studied in the class, whatever you studied in your life, everything is included in analysis and interpretation. The most important thing in analysis and interpretation is that whatever you can see in the figures, that may not be correct 99% times. Suppose you are saying that Saraf Academy and other organization in the training classes for these courses only. Saraf Academy profit, sales are more, but the other organization profit is less. We can't say that Saraf Academy is good. Just by looking at the profit of figures, figure of profit, I can say Saraf Academy is good. Because calculation of profit, bringing profit is the accountant's job. Following different accounting policies, recognition, we can change the profit whatever we like. Generally, a knowledgeable person will say that to the client or to the, you can say, employer, what profit you want. By changing the inventory policy, non-current asset policy, or you can say that investment property policy, everywhere. The accounts does not say that you have to do this. Always accounts says that you can do this, you can do that, you can do this. Options are there. Because accounts is not science. The same thing, you will be doing a treatment differently. I am doing it differently. We both are correct. But then the comparison is not possible between me and you. Because I have done the treatment in a different way. You have done the treatment in a different way. So for analysis and interpretation, the most thing is what? Most important thing. Do we know the concept behind that? Do we know that what are the options available in that case? In that transactions, how it has been recorded by the two organization or our organization only in the past and in the current year. Maybe earlier we were following a different accounting policy. In the current year, we have changed the policy. So when the policy has been changed, we understand that we cannot do the comparison. The comparison can be done between our financials of current year with the past year, or the comparison with the other competitors when the policies are same. So before going for figures comparison, we need to go how the figures has been derived. Whether there is a different policy followed by the organization, then only we can compare. Because We need to make them on the same base, on the same page. Then only comparison can be done. Otherwise not. So comparison is a very high level of thinking. It cannot be done by a normal person. Maybe suppose you will say that, anybody will say that, me or you can say that, I have been studying accounts for 30 years. Still some areas I will find that where I am not able to think that much which they are thinking. Because my knowledge is not superpower. The problems arises that whether in any exam, whether in ACCA, SBL also, the comparison analysis will be there. And you can say that any exam, CIMA, CPA, ACCA, Indian courses, this is the most difficult area. The reason being that what is the syllabus of this chapter? Everything. Everything, whatever is there in the accounts is the syllabus for this chapter. And at the same time, an analytical skill. Suppose you are comparing sales of last year and current year, or you are comparing sales of current year, our organization and another organization. If the sales is more or less, it's good, but you need to go into deep. Why the sale has gone up? Because of quantity, because of price. Because two things in the sales. The third thing is that if the company is dealing in different products, then the sales mix also. That because of which product the sales has gone up. If the sale has gone up because of quantity by sacrificing the price, it's not good. Because if you are increasing your sales by reducing the prices, you will not be able to survive. Because how long you will reduce the prices continuously? It's very difficult. If the sales are increasing without compromising on the price, then it is called logical. Then if the company has different products, then we need to see that because of which product the sales has gone up. What is the future of that product? What policy action policy action means not accounting policy. What company is doing in the marketing, in strategic decisions relating to that product? Why the sale has gone up? Why the other product sale has gone down? It's only a sales figure. Somebody can say that our sale is greater than last year by 10%. Very good. It's not like that. Because that can be said by a person who has never studied accounts. He will say 10,000, 11,000, 10% up. But we as a proper analytical person need to go into deep. Why the sale has gone up? This is relevant in finance and auditing also. When you are doing auditing for a client, you will not be checking all the vouchers, all the sales, all the customers, ledger, everything. We don't get time. We need to analyze the financials and then we decide where we will be going into deep. Where we will be going for substantial procedure, substantial checking. We always do what I should say, sampling. While doing auditing, we do a sample test of the transactions and systems. Where what sample we should be taking, that judgment is required. Along with the statistics, the judgment is required. So whether you do auditing, whether you do a financial analysis, whether you are studying accounts, this part can be done only by a person who has very, very sound knowledge, who understand accounts, IS, IFRS very fantastically, so that he can point out the differences very fast. That actually the differences is for what reason it is good or bad, that can be interpreted. When we say good or bad, there are two ways to say good or bad. One is with the help of ratios, profitability, gross profit, net profit, operating profit, return on capital employed. In terms of asset utilization, you can say turnover ratios, asset turnover, capital turnover, receivable turnover, inventory turnover, whether we are utilizing our assets efficiently or not. You can say that whether the company is more risky or not, debt equity ratio, interest coverage ratio. You can say that whether the company will be able to pay short-term liabilities in time. For paying my creditors, I will not sell my land and building. My current assets will be used for payment of current liabilities. So whether the company has adequate liquidity, current assets are sufficient to pay the current liabilities. And in a listed company, generally we refer investor ratios also. Price earning ratio, dividend coverage, dividend cover. Then you can see that earnings cover. We consider those ratios. At the same time, when a company is listed, they will be presenting their cash flow statement. For a non-listed Saraf Academy, cash flow is not required. So we will be calculating, analyzing ratios based on cash flow also. It's not essential that I will be calculating ratios, then only I can comment. Other than ratios, I can do a write-up. I can say why the differences are there. That also I can do. But with the ratio, when you present the report to the board members, in the board members, the directors are there, executive, non-executive directors. You present the ratios, they will be able to understand faster. So the interpretation and analysis can be done on the basis of ratios, or maybe on the basis of a thesis, on the basis of a write-up. But before calculating ratios, before going into thesis, you need to understand that whether the figures are comparable, whether there any change in accounting policy. For that reason, they are not comparable. First, make the accounting policy same. First, make the figures so that they can be compared. That is your task in the exam also, in the practical life also. The second thing, if we are saying that the ratios are good or bad, or maybe the in theoretical term, after doing the adjustments, rectifying the, bringing it on the same page, we are saying good or bad. Generally, we need to advise also what should be done. That if this is bad, what should be done? If this is good, how that can be carried forward, how that can be done. Because even though we are analyzing based on the past data, but ultimately the analysis and interpretation for future. The accounts does not say about future, but we as an analyst need to say about futures of the company based on the past data, based on the competitors' data comparison. We need to say, advise the organization how they can improve, where their performance is actually good or bad. That we need to critically see. Now, the problem is that if I will say that in a company sales is very up, and it's actually up, profit is up, everything is good. But in the company, there are something happened which are not recorded in financials. There is a major customer who has already communicated he will not purchase goods from the company. There is a director who is very important for the company. He will not be able to work in the company as director, or maybe he has died. There are some research and development we were doing, but it is unsuccessful. The whole research gone, and in future we are not able to do that research. Something which are not written in the books of accounts, but has a good significance, important significance. In a company, maybe the company is facing problem with the customers, the case laws and all that. In a company, the employees are not sticking. They are leaving the organization. Employee turnover is very high. All these are treated as non-financial measures. According to me, the financials we will get when the non-financials are good. When the non-financials are not good, then the financials we will never get correct. So the analysis is not only focusing on financial area, but on the non-financial also. Now in the non-financial, there is no limit. But the non-financials we understand as an accountant, as an analyst, they will affect our financials, which we say in costing or management accounting balance scorecard. Financial, internal, customer. Here balance scorecard is not written, but just I'm saying that indirectly it's a balance scorecard only. That you cannot say that on the basis of financials, or comment cannot be correct, may not be appropriate unless and until you analyze non-financial data also. You need to analyze customers, complaints, employees, staff, effect on the customers, effect on internal efficiency, new asset purchase, R&D. All these things are non-financial, but that also need to be analyzed while reporting or analyzing or interpreting about the financials of the company. Now for these non-financial, there is no rule as such. For financials, so we have PL account, balance sheet, these are the rules. For non-financials, there is no rule. For non-financial, it's on me, it's on Ravinder, it's on Srasti, it's on anybody. What are the non-financial areas, how and what you will be doing. But the whole world is moving in a different direction. Whole world in the sense, those who are knowledgeable, not that common man. In the world, there is a new concept is being developed in last, I will say, 10 years. Integrated reporting, global reporting initiatives. The integrated reporting and global reporting initiatives are focusing on financial statement write-up. PL account, balance sheet will be same. But in the notes to accounts, we can say that we will be reporting integrated reporting. We will be reporting these aspects as per guidelines. Those integrated reporting guidelines are not compulsory generally in most of the part of the world. I don't know exactly, but in some of the countries, they have been made compulsory. But in India, I don't think so. It is going to be compulsory for coming 3-4 years. But that doesn't mean that we as an accountant or analyst don't need to know that. We have to know that what changes are happening at global level, what they are saying about representation of non-financial area, which is non-financial but which affect our financials. What the company is doing for environment, how much company is doing carbon emissions, how much the company can say that they are satisfying customers, how the company is dealing with the local economy, how the company is dealing with the local suppliers, local employees. We all know that recently the whole India is moving China, made in China goods we will not be purchasing. We should be self-dependent, self-reliance. Everywhere it is happening. It's not only in India. In US also H1B visa and all that, all those things. I'm not going into that detail, but I just want to say that if I'm in India and I'm not helping Indians, you can say suppliers, customers, employees, staff, that means I'm not a good person. I'm not a good organization. So what I'm doing for my local person, for protecting economy, whether I'm paying taxes or not, whether I have a good employee policy, ethical policies for my employees, whether I'm paying proper wages to them or not, whether I'm taking action for protecting the environment, all these things are becoming important day by day. Maybe in a country like India, it has not gained that much importance, but in developed country, that is gaining importance like anything. The integrated reporting is focusing on that area, that you are not doing business just for your own. Whatever business you are doing, trading, manufacturing, service provider, anything, but you are doing for the country to which you belongs. You are getting so many things from the country to which you belongs. So you have to do something, and what you are doing. The integrated reporting is focusing on sustainability. If I am using the resources, energy, whatever, more than it is desired, the energy will not be available for future generation. How can I say that I will be sustainable for a long time? Business must go on, so must go on. And at the same time, because of my activities, the society is not getting adversely affected. What I'm doing for that? What is I'm doing? That need to be reported in integrated reporting. The guidelines are there. They have not written the entire guidelines in the book. You can go into Google, integrated reporting. You will get pages and pages. But ultimately, what is the crux of the guidelines? If I will say that, suppose I know accounts. It's not that in IAS paragraph 1, paragraph 2, paragraph 3, I remember. And I'm not interested also. Because how can I remember paragraph by paragraph? When I will be doing any practical work, which I need to submit in a regulatory platform or something, I have the right to open the paragraph by paragraph. I can mention in IAS 1, paragraph 4, this is written. I can mention. But in the exam, if it is written in the answer, they are writing paragraph 1. I don't think so I can remember this. It's beyond the human being capacity. So I'm never focusing on paragraph 1, 2, 3, whatever they are writing. Because that's they are writing from referring the IAS 1, putting in front of them, and then they are writing paragraph 2, 3, 4. I cannot write. I can write as per IAS 1, IAS 5, that I can write. I cannot write paragraph. But I'm just saying that in practical world, I will be writing because I will be referring the paragraph. Similarly, in integrated reporting, they have written paragraph wise the guidelines. So when I will be doing a practical integrated reporting, I will be writing this is written in this paragraph relating to economic development, this point, relating to social, this point, relating to environment, this point, I can write. There is no problem. But when I am giving exam or I am just discussing, how can I remember this paragraph says this? That is illogical. So my study if focus on paragraphs, then it's impossible to give an exam or to, you can say, grasp anything. The basic purpose of integrated reporting is recording non-financials and integrated reporting focusing on sustainability reporting. It's not that you are earning good income, sales is more, that means you are good. What you are doing for the society with your operations, how can you say that the society will be positively getting benefited? What you are doing for the society, for environment, for local persons, for nationals, what are the things you are doing? How can you say that you will be able to do the business for coming whole life? Because going concern principle cannot be seen just by the financials. We need to go into deeper that whether the company will be able to maintain the going concern principle. So that is, you can say, integrated reporting guidelines, non-financial data need to be reported. Now the problem arises that in India presently and in many countries, 99.99% countries, there is no rule what ratios the company will be showing in the notes to accounts. Which ratio I calculate? There is no accounting standard for this. IAS 1 to IAS 41, IFRS 1 to IFRS 16. Up till now, as on today, these are the total rules. But there is not a single IAS IFRS says that the company will be analyzing, interpreting their financials, incorporating integrated and all that. They should show these ratios and all that. There is no rules. Now, you will see in the practical world when a company's profit goes down, the directors, the chairman speech, and in the notes to accounts they write why the profit gone down. Or if the company's profit up, or maybe if the company is, you can say, a public limited company where government stake is there, or a not-for-profit oriented organization, they disclose many things which are not required by law, which are not required by IAS, IFRS. Is this justified that they are disclosing those things? Justified. But the motive should be positive, should not be negative. If your figures are not giving good picture and you are saying bogus thing in the notes to accounts, you are actually manipulating the data and you are actually, what I should say, you are against the public policy, then that is not allowed. You as an accountant, me as an accountant should not be doing that. Maybe in practical life you are forced to do that. That's other thing. But in the exam you need to be ethical. That if in the notes to accounts company is writing something which is changing the picture what is actually there, then I will suggest this type of disclosures is not advisable. This is unethical. This is non-professionalism. How the company can do something which is actually not apparent, because everybody is not knowledgeable like me and you. The whole world is very layman. So if the company is saying something, they are misrepresenting the facts by doing some disclosures, that is never allowed. That should not be done. So in the exams, mainly SBR exams, they ask a question on additional performance measures. In every paper, APM, additional performance measures. Sometimes a 5-7 marks question, sometimes a 10-15 marks question every term, which is not related with any particular IAS IFRS, which is saying that a company is doing additional disclosures, additional performance measures in their notes to accounts this much. You say whether the said by the company is correct or not. You do a critical analysis. You say that it is allowed or not. So sometimes you will find that in these solutions, they have written that it is very much logical. It should be given by the company. It is correct. It will help the investors or anybody like this. Sometimes they say that company is misrepresenting the facts. By doing the additional disclosures, they are hiding the facts which was there in the financials. They should not be done. Now, in which area, what should be the write-up? I can't say generally. It depends upon the case. The case depends upon our sound knowledge of IAS, IFRS. If a company is disclosing in notes to accounts gross profit, net profit, operating profit, current ratio, quick ratio, debt equity, there is no accounting standard IAS, IFRS which says that these ratios should be disclosed. The company can disclose. Nobody is questioning. But what is the purpose of disclosure? That we need to go into deep. Whether these additional disclosures are misrepresenting the facts, they are given for misrepresenting to the public, not allowed. But if they are given for genuine purpose, for so that the public can take informed decisions, and they have been additional disclosure is presented in a proper way, then in that case our advice that the company should be doing that as an ethical person, as an ethical accountant. For this area, there is no specific study I can say. Obviously, whatever is there in the chapter, we will study. I'm not questioning. But it's not that whatever is there in the chapter is the only things. There are thousands of things possible. Every term, the question paper can have APM different. Every paper. So if you are doing the last term papers or you are doing question, don't try to mug up. Don't try to read the answer. Maybe you will be wrong. But you have studied that IAS, IFRS. If you don't remember, open that IAS, IFRS. Read that. What is the story behind that? Then write your answers. Then see the solution. Because This chapter requires everything you should be doing on your own. If you read the solutions, that will not be good. Do on your own. After doing, obviously you have to read the solutions. If you have done correct, still you will find that they have written something which you have not written. You need to increase your level. You need to make your notes like that. And then later on, you will not be reading Kaplan or question paper. You will be doing your own notes study, which I said in the beginning also. So the chapter involves ratios. Chapter involves some non-financial measures in general. Chapter involves integrated reporting, that in the world, financial, non-financials are combined for sustainability integrated reporting. And chapter involves a paragraph on not-for-profit oriented organizations' financial performance, because they are not working for generating income. They are working for break even. They have a broader objective than a profit-making organization. So their analysis need to be done in a different way. The four things are broadly covered in the chapter: ratios, interpretation analysis through the ratios. The second thing, non-financial measures in general. The third thing, integrated reporting guidelines. That is, in the world, what is happening for sustainability and financial, non-financial mixed. And the last thing, not for profit oriented organizations, interpretations and analysis. Those are the areas covered, but those areas does not belong to any specific IAS or IFRS. They are relating to the entire syllabus. So I can say that analysis and interpretation involves ratios, involves non-financial measures, involves integrated reporting, involves not for profit organizations financials appraisal. We need to understand that why I am writing. It's just that the reason is that everything is written in the Kaplan. Everything is written in all the books. Maybe in pocket notes also it is written, obviously. But till the time I will not write, I will not get the feeling. Even in teaching. So if we are studying on our own, till the time we are not writing, we will never get a feeling. Maybe we are studying 10 books, 10 places, we are doing 1,000 questions. That will never be over. And the short notes is mine only. The short notes mine means not what I am writing in the slides, your own notes. That short notes, pocket notes will help you during the time of exam. No any notes will help you during the time of exam. And since we are studying one subject, today, tomorrow, day after tomorrow, every day, that is more than enough time is there even to start now and to score 90 in the exam. Suppose I will say, Srasti, you have joined it today, but there is no problem in giving exam in September. Enough time is there. You are not going to study 5-6 subjects like CA. You are going to study only one subject which you take your call. And one subject we can study fantastically, but we need to approach it in a right direction. Wrong direction approach is not logical. If we need to study through the materials, then why we have joined the classes? What is the benefit of classes? Because then you are wasting your money. You have joined here for knowledge from my side, what I know, what I will communicate, not for the books. Books are secondary. So do the recordings, do the live class, make yourself understand, do the things on your own. Then only the things will be very clear. And then only we can become superpower. Not by reading the books, because reading the books, why you will waste time on me and giving money to me? Time and money, both are getting wasted. That is not required. I'm not writing everything. I'm just writing in short what we have discussed in the chapter. What is introduction? What is actually the feel of the chapter? Now, if somebody will say ratio, is there any limit for ratios? I don't think so. There is any limit of ratios. There can be endless ratios. You go on writing the ratio, it will never finish. Anything numerator, denominator becomes a ratio. Anything. But then, since whenever we have studied ratios, the ratios are common. And most of the ratios we remember. We don't have to remember. They are divided into profitability ratios, then liquidity ratios, then solvency ratios. I should say liquidity and solvency is short term. I will say capital structure ratios, then I will say asset utilization ratios, and then I will say the last one, investors ratios. The investor ratios are not relevant in a company like Saraf Academy because me and my wife is investor. We already know everything in the company. The investor ratios are relevant for bigger companies, listed companies. Because so many investors are there, you can say that which is a very big company, investor ratios are relevant for them. These are the broad categories. Now in profitability, how many ratios you calculate, it's upon you. There is no limit. You can calculate ratios for every expenditure. Cost of goods sold as a percentage of sale, gross profit as a percentage of sale, administration as a percentage of sale. There is no limit. You can do ratio analysis thousands. There is nobody is asking you question. But there is no IS, IFRS, which ratios is important or which ratios. I can say only one IAS 33 EPS for listed company says how to calculate EPS. That's only the ratio which is said by any accounting standard. But not other than this, there is no IS, IFRS or any accounting language says that this is the ratio in this category. वो आपकी मर्जी है. It's upon you which you want to say as a ratio or not. Since the ratios are pretty common, most of the ratios we already know. So our objective is not to understand calculation of ratio. Our objective is to go into slightly deep in the ratio, what the ratio want to convey. That we are discussing. Suppose gross profit margin, they are saying. The gross profit may be increasing because of high selling price, because of lower purchase cost, because of change in the sales mix. Your gross profit is sales minus cost of goods sold. So either your sale is more or less, your cost is more or less. So ultimately your gross profit is getting affected. Why your sale is more or less? Because of sale price, because of sale quantity, or I can say that because of change in the mix. Or maybe your sale is same, but your cost is going up or going down. Why it is going up or going down? Some change in the technology, some change in the system, production method. Maybe you are getting bulk discount, whatever. It's just we are saying that when we will be analyzing gross profit, we need to go just beyond the percentage. From last year to current year, the percentage is more or less. Our gross profit margin as compared to our competitor is more or less. It's not that it's more or less gone. Inventory policy, they have not written. Inventory can be valued FIFO, average. Every method of inventory will change the gross profit. So if your inventory valuation method and your competitor inventory valuation method or your previous year inventory valuation method was not same, you can't compare the data. Gross profit margin non-comparable. First of all, bring them on the same line. Then only you can do comparison. So we understand that at our level, They are not going to say gross profit last year 20%, current year 21%, and you start saying it is good. They want it a deeper analysis. Maybe something is not written in the question, because in question they cannot give you everything. But you need to be very critical in your saying. You cannot say up, bad, good, down, bad, and all that. You have to go slightly deeper. Operating profit, that is from gross profit we have deducted further operational expenditures. You can see as per income statement, admin and selling. Administration and selling and distribution expenditure, when we deduct, then we get operating income. That means in the operating profit margin, the effect of administration and selling is also there. We know that administration expenditure is fixed. It's not a variable expenditure. Administration expenditure is always fixed. In my office, if 10 persons are working, salary is there, same. Because of COVID, maybe there is some changes. That's other thing. But normally the fixed expenses don't change. Whether your revenue goes up, goes down. So if your revenue is down and the fixed expenses are not changing, your profitability, operating profit will be very highly affected. And maybe if your gross profit is down, then the operating profit will definitely be down. Because gross profit is already down and the fixed expenses are already same. So your operating profit will be further going down. But why it is happening? What is the reason behind that? Operating profit margin is affected by more factors than gross profit. Many operating costs are fixed and therefore do not necessarily increase or decrease with revenue. This means that operating profit margin may be more volatile from year to year than the gross profit margin. You will generally find that if you compare last year to current year or competitor 5 financials, you will find that the difference, the changes in the operating profit deviation are more as compared to gross profit, because other items are included in that. Be aware that many operating costs such as depreciation, impairment are heavily reliant on management judgment. Depreciation is straight line, WDV, change in rate, revaluation, so many things are there. Then you can see impairment. Impairment is, yeah, IAS is there, IAS 36 impairment. But whether the IAS says that this will be the impairment, that's your lookout. That's your calculation, which is not a cash expenditure, which is based on management estimation, forecasting. So many things are there. That is also questioning about operating profit margin, good or bad. This may hinder the ability to compare the operating profit margin of one company with another company, current year with the previous year. So you can say that in operating profit margin, in entire IAS IFRS relating to non-current asset is included. Whatever we studied in IAS IFRS, whether it's an IAS 16 property, plant and equipment, IAS 20 government grant, IAS 40 investment property, then you can see that IAS 36 impairment, IAS 38 research and development, IFRS 5 non-current asset held for sale and discontinued operations, everything is included here. They can give any question on anything. There is no limit. Because if the operating profit is up or down, that's not the logic. They are doing window dressing, which is regularly happening on CNBC in the market. What can we do? We cannot make the accounts as a science. Accounts is not science. There will be options. There will be possibilities that the treatment can be like this. We can't stop that. Maybe not today, and maybe even when I will die after 20 years, you all will die after 40 years, then also. It will remain like this only. Accounts is not science. A return on capital employed. Now here, earlier the two ratios were based on income statement. Now this is based on income statement and balance sheet combined. Numerator is income statement, denominator is balance sheet. Capital employed is all the fixed interest bearing liabilities. That means equity. Share capital, retained earning, reserves and surplus, revaluation, reserve, everything. Non-current liability. In the current liability, if it is interest bearing, bank overdraft, that also. Somebody will say that, sir, I will take only the long term. I will not take the short term. Not a problem, man. At your level, the question is not saying that if you take bank overdraft in denominator or you don't take, it is wrong. It's upon you. Because the capital employed figures are always different by different calculations. Here it is written all interest bearing finance. Why? Because when we are taking operating income means sales minus cost of goods sold minus administration minus selling and distribution. It is not deducting interest on any type of loan. So for that reason, denominator is including all the interest bearing liabilities. Maybe they are short term, but it's not compulsory. Reason being that I am giving you logic. If I have taken bank overdraft, through the bank overdraft money, I am doing my manufacturing operations. The interest cost on bank overdraft I am considering under cost of goods sold. So it is deducted in operating income. So in the capital employed, I should not be taking the bank overdraft. The logic is there. Whether I will take or not, it's not wrong or right. What they are saying, what you can do, it's upon you, because there is no fixed guidelines for a ratio. What the ratio want to convey? Actually, the ratio can be broken down into two parts. A return on capital employed, which we are saying operating profit divided by capital employed. I am breaking this down into two things. Operating profit margin multiplied by capital turnover. So breakup is operating profit divided by sales, and then the second one is sales divided by capital employed. Ultimately, sales in the first one denominator, in the second one numerator, cancelled out. So it becomes operating profit by capital employed. But there is a good thing we can understand. The first part is saying that in the sales, how much is your operating income? That is how you are controlling your expenses. The operating profit will be more when you are able to control your expenditures. But the second part, sales by capital employed, whatever my capital employed, debt and equity, I have invested in the business. How much I am generating sales from them? If the assets are efficiently utilized, I am able to generate more and more sales. And the sales is converted into income in a better way. The expenditures are controlled. Then only the operating return on capital employed will be improving. And you understand that the operating profit can be further broken down into gross profit, admin expenditure as a percentage of sales, selling as a percentage of sale. Capital employed can be broken down into fixed assets, into current assets, because fixed assets plus net current assets. Ultimately, this is entire business analysis. If your return on capital employed from last year to current year has gone up or gone down, it is entire business. The control of expenditures, the generation of revenue, the asset utilization, everything. But not that if it is good, good, bad, bad, up, good, down, bad. Because maybe you have changed the policy. There are so many things involved in asset valuation. So many things, accounting standards are there. Just a simple example, suppose I have purchased the property for investment purpose, not for business use. Now the investment property can be disclosed at cost or market value. Anyone? That's upon you. If you follow the cost principle, you will charge a depreciation like a normal asset. That means depreciation will be an expense. If you follow the revaluation model, no depreciation, just the increase or a decrease in the value, you will be recording in the income statement. Now please understand, Saraf Academy is recording cost model. We are recording depreciation. Some other organization is following revaluation model. They are not recording depreciation and the property value gone up. They have recorded income. So their income will be definitely more than ours. Can we say that they are better than us? Can't say. Can we say that I am bad than them? Can't say. The different accounting policy we are following. Like this, there are thousands of policies. I am following revaluation model for my business assets. That company is not following. So revaluation, the assets value gone up, the interest cost, the depreciation has gone up. In that case, they're not gone up. They are competitor, but they are not following the same policy. How can I say that I'm better than him or worse than him? Can't say. Unless and until the figures are not on the same page, the comparison is meaningless. In short, we can say if the operating profit is going up because of two factors, but we need to go into detail why the operating profit is going up or going down. The first is control of expenditures. Then only from sales you will be getting income. The second is realization of sales. How the assets are utilized. Whatever assets I have, I am generating a revenue. My competitor is also in the same business, same industry. Maybe his assets are not equal than mine. Suppose I have 5 crore assets. Sales is 2 crore. So it is 2 crore by 5 crore, 0.4. But in the other organization, the assets are 1 crore. Not a problem. The sales is 50 lakh. 50 lakh by 1 crore is 0.5. So with the $1 assets, with the $1 capital, I am generating a sales of $0.4. They are in the same business. They are generating with $1, $0.5. If there is no ghapla, there is no misrepresentation. The policy which I am following for my assets, for my sales recording, they are following the same policy. There is no difference in the policy. I can say that they are better than me. Maybe they are smaller. I have 5 crore assets, they have 1 crore assets, but still they are better than me because they are able to utilize $1 assets generating $0.5 sales, but I am generating only $0.4 sales. But for this meaningful comparison, first of all, the policy of the two organizations should be same. Then only, otherwise not. So they are saying previous year figures, you can compare when you compare for some years. The target ROC, the company must have a target in their mind. The competitor analysis, the cost of borrowing. Why we need to see cost of borrowing? Because we compare return on capital employed with the cost of borrowing. If in the market the interest rate on loan in India is say 10%, I should be generating whether we have taken loan or not on my capital greater than 10%, because then I am not earning properly. So cost of borrowing is not a calculation you will involve, but you compare that whether our return on capital employed is greater than cost of borrowing or not. That we need to check. If we have actually borrowed, then we are paying 10%. I am earning 8%. Then I am not able to done business. I will not be able to survive. Maybe a not for profit oriented organization. I will not. How I will pay 10% by earning 8%? For that reason, cost of borrowing need to be taken into consideration. These are the profitability ratios they have given. But it's not that this is a limit. Any ratio you like, you can calculate and all that. There is no limit. Just 1 second. Coming. 1 second. Sorry. So these are the profitability ratios they have given in the material, but in exam they can ask any profitability ratio, net profit margin, you can say return on equity, anything. They can ask net profit margin, return on equity. They have stated in terms of EPS. For that reason, maybe they have not written here, but any ratios can be given in the exam. We need to critically analyze why it is going up or down after making the policies equal. After making the policies of last year or competitor same, then only. Otherwise, it's a meaningless comparison. The liquidity, whether we can pay our short-term liabilities, creditors, salaries, accounts payable, anything in regular time, whether we are solvent in short-term basis. The most important ratio is current ratio. Measures whether an entity has sufficient current assets to meet its short-term obligations. The higher the ratio, the more financially secure the entity. However, if the ratio is too high, then it may suggest inefficiencies in working capital. You can say that. Now, in many books, you must have studied that current ratio should be 2:1. It is not correct. It depends upon industry, nature of business. In some industries, maybe it is 3:1, 4:1 is correct. Why? Because in that company, regular cash inflows are not there. When we sell goods, we get the money, say, after 7 months, 8 months. In some companies, maybe it is 1:1, then also it is good. Because that industry, suppose in my business, I am to regularly getting cash from the students. So what's the problem in making payment of liabilities? I don't have any inventory. There is no receivable. In my current assets, cash and bank balance. So my cash and bank balance is enough to pay the current liabilities which are there. Then what's the issue? So we can't say that there is any standard norm for current ratio. It depends upon case to case basis. Now here they should have calculated quick ratio also. Current assets minus stock divided by current liability, but they have not given. Because in current ratio, current assets includes inventory. And inventory cannot be used for payment to creditors. So for that reason, when we calculate quick ratio, then we ignore stock. That is better, but they have not given. But they can give an exam, no issue. Then they are talking about asset utilization. Or they are saying that even though your ratio is high, current ratio, but still it is bad. That also they are communicating. They are saying that inventory as a percentage of cost of sales is coming something. Suppose 100 days. Inventory 1 lakh. Cost of sale is 3 lakh. So 1 lakh divided by 3 lakh. 3 lakh in 365 days. So 1 lakh inventory in how many days? 100 days. That means we are keeping inventory in our stock of 100 days. Is it required that this much inventory we should be keeping? Why we are keeping 100 days inventory? What our competitors are doing? Are we any time found that we are not able to sell the goods in the past? That we need to check. That maybe the inventory is more than what we require. Maybe still 1 lakh is less. Depending upon our business, there can be very large orders in the past also can come. So for that reason, maybe we are keeping less. So inventory and all that we are analyzing. The breakup of the current assets. Lack of demand, poor inventory management, receivables. Again, if I will say that the receivables are very high, maybe we are not able to collect from them properly. They are not giving us money. Our collection efforts are not proper. The current assets are more. But the current assets include receivables which are not paying for a long time. That means maybe they are high, but it is not good. Payables. Generally, we want that the payables we should be making payment as long as possible because we are getting interest-free money from the payables. If I am purchasing goods of $1 lakh, I need to pay $1 lakh after 2 months, not the interest. So we always want that we should be able to get the credit much more. But then if you are giving payment very long as compared to competitors or the industry norm, the goods supplier will not be with you. They will not be interested in selling goods to you on such a credit terms, bad quality, and then the problems will be arising. That should not be happening. We should be increasing our credit terms or the credit whichever is possible, but within a limit with the business norms. It's not that only those 3 other areas, cash and cash equivalent, how much we are keeping. If we are keeping more than our regular expenditures, it's a wastage of interest and all that. That is also there. But need to be analyzed the breakup for analyzing liquidity ratio. The long term, If I am taking loan from bank for 10 years, now I don't have to check that whether I have money to pay the loan now, because I will repay the loan after 10 years. Why I will check now whether I have money or not? So in a long term funding, when it is from debt, then the understanding, or you can say inference, is different. We say that debt is more riskier than equity. For debt, we have to pay interest, we have to repay the debt. For equity, there is no interest dividend, there is no commitment. For equity, there is no repayment. So when the company go for more debt, then the commitment, the risk increases. So we need to analyze from the company's debt and equity. Now debt is only long term, not short term, non-current liability only. Preference share is a part of debt only. Why? Because preference share also involves commitment to pay dividend, commitment for repayment. So they are treated in accounting language, IAS, Ind AS, as debt only. So you can say that debt and equity ratio will say the riskier capital and the non-riskier capital. When the riskier capital is more, maybe a problem with the organization to serve the debt. Maybe when the company will not be able to pay the interest or the principal whenever it is required, they will be liquidated. They will face insolvency petitions and everything. All those things will arise. So we need to analyze how, on the basis of past data, on the basis of competitors, that we need to analyze. But at the same time, the financial instrument says how can we value debt, whether they are properly fair valued or not, that also need to be checked. Because if the value is wrong, then calculating debt equity ratio does not have any meaning. Suppose lease. In lease, we discussed that when the lease is greater than 12 months, then in that case, we need to record the lease as a debt. But the company is not recording lease as a debt. That means there is no purpose of calculating debt equity ratio when lease is not included in debt. First of all, need to rectify the figures, and then you can calculate debt and equity ratio and take a call whether it is high or low based on competitors, based on business, based on our past data. For debt, when it is high or low, we judge from the interest coverage, that whatever interest we need to pay on the long term debt, how much profit we have for payment of interest. Because operating profit, sales minus cost of goods sold minus admin minus selling, that is without deducting interest. From that operating profit, we will pay interest. Suppose I need to pay interest, finance cost $1 lakh, and my operating income, operating profit is already $5 lakh. 5 times. To pay $1, I have $5. Very good. Generally around 3 or greater than 3 is treated as good, but you cannot write 5 is good and all. You need to check that in the operating profit, everything is calculated properly. Whether the company is doing window dressing, dubious accounting policies, because of which operating profit is more. Or maybe the company is charging many expenditure, impairment and all that, which are as per good policy. But the profit, cash profit is very high for payment of interest. That also need to be checked. Then comes investor ratios. You can say price earning ratio is most important ratio in the world. What is the market price of shares of the company and what is the earnings per share? Suppose I will say that in India, in banking industry, banking, the ratio is hovering around for ICICI Bank, HDFC Bank, Kotak Bank. These are private banks, State Bank and all that. It is hovering around say 12 to 13 times. That means if $1 the banking company is generating, then the price is 13 times. So if any bank profit will increase, say by $1, its price will increase by $13. And if the earnings of a bank will go down by $1, the price will go down by $13. Suppose I see IT companies, Infosys, TCS. Many companies are there, Wipro. In IT industry, suppose the ratio is 20 times. That means the people are giving more importance to this industry than the banking industry. For $1 earning, the price is 20 times. Whether it will remain in future or not, nobody knows. But if it is 20 times, that means for change in earnings, the effect on the price will be higher in case of IT industry. If I am an investor, I need to decide what is my purpose of investment. Whether I want capital appreciation or whether I want a dividend fixed income. Those companies whose price earning ratio is high, or in those industry where price earning ratio is high, I will be investing in that industry if I want capital appreciation. Because those companies are generally paying less dividend. They are investing most of their money earned in the business only. And since they are investing more and more money in business, their earnings will increase faster. And when their earnings will increase faster, the price will increase faster, I will be getting capital appreciation. But if the earnings will go down by chance, then the price will go down very fast also. So risk is there. If I'm thinking capital appreciation, it can be capital depreciation also. Because of any reason, maybe the company's management, internal or external factors. But if I'm a person who don't want to take high risk, I want regular incomes. I don't want so much capital appreciation. So I'm looking at those companies who have a very good kind of business, not so much investment required in the business. You can say iron and steel, you can say Hindalco, any company which are dealing in something which is perennial. And they have a track record. Regularly they are paying dividend. Whether their profit is up or down, they are regularly paying dividend. Whether the share prices are going up or down, they are regularly paying dividend. Then I will be investing in those companies where P ratio is less, but they are giving me regular income. I don't want to take much risk. So if the prices will go down, the loss will be less. If the prices go up, the income will be less. But the major income is regular income. Generally, we say that young persons, young investors, aggressive investors invest in those stocks where P ratio is more. And old age persons, or you can say defensive investor, invest in those stocks where P ratio is less. But then the P ratio depends upon earnings per share. What we are doing in earnings per share, is the calculation correct or not? Since the earnings per share is so important that for every company P ratio is presented in the newspaper, in the articles, in the CNBC, everywhere freely available. So the earnings per share is affecting your P ratio so much. Whole over world, not only in India, all over world there is a rule. How can you calculate earnings per share? So that you cannot do window dressing in this area. You cannot do whatever you like. There are rules, guidelines, which we need to follow for EPS, and then only we can say. But still, the rules, guidelines are not like science. It is relating to certain areas, they are like science. But my profit up or down depends upon so many accounting policies, non-current assets, intangible assets, impairment and all that. The EPS is not saying that you have to calculate depreciation like this only. You have to value inventory like this only. So again, even though there are guidelines for calculation of EPS by IAS 33, by Indian AS, I'm not questioning. But they are not saying that you cannot do window dressing. Window dressing, so we will be doing for whole life. So when we compare two companies, we need to see the earnings are on the same basis calculated or not. Then only we can compare, otherwise not. But it is one of the important ratio for investors to take their call whether they should invest in the company or not. The P ratio represents the market view of the future prospects of the entities. A high P ratio is a growth company going to give capital appreciation. The calculation of EPS is revised in the next section, which they are revising in the next section. You can see that EPS is actually as far as SBR student is concerned, generally it is assumed that the student has 100% knowledge of EPS because they already have got the exemption because of CA or CMA, or maybe they are coming from a skill level. In a skill level, they have studied detailed EPS, but still they have covered here, not in that much examples and all that, but basically they have covered so that if any question come, we cannot ask. You can say that IS2 inventory. They can ask any question. It's not that they cannot ask. But generally, since the exams is of upper level, the questions on those areas which are very basics are asked less. I can say that in every exam of SBR or maybe IFRS, 5-7 marks question are on very basic area, which is very basic. You can say accrual concept, going concern, you can say format of financials, you can say inventory, anything they can ask. And they ask that whether your basics are clear or not. Generally, the basics when they ask, those they are asked with current issues. There must be something happened in those areas. For that reason, they ask questions on that. So when I will be going through the current issues in next class or maybe next to next class, then we will be able to encounter that also. Obviously, there is no limit for the basic accounting also, but then they generally focus on current issues. So then we will focus on those areas where recently in 5-6 months, 1 year, some changes, some not changes, some further explanation, some further notification came and all that we will discuss in that class. But for the timing, I'm not focusing on that. I'm focusing on now calculation of EPS. The ratios which we have discussed, they are not the only ratio. There is no limit for the ratios. But as a basics, they have given these ratios. In the investor also, dividend cover, dividend by earnings. In the earnings by dividend, earnings yield, reverse of P ratio, earnings divided by price, ratios are there. But ultimately they hovering around P ratio only. For that reason, other ratios are not given. Now, how to calculate earnings per share? Earnings per share means profit of the company for the shareholders divided by number of shares. That should be the simple principle. Profit of the company for the shareholders divided by the number of shares, but profit of the company without deducting dividend. We are not saying that the company is paying dividend, will pay dividend, will not pay. Earnings belongs to shareholders. Profit of the company divided by number of shares. It's very simple. But the problem is that the number of shares, if from beginning till the end of the year it is same, not a problem. But if the number of shares during the year had changed, at the beginning some shares were there, the company issued further shares during the year, the company issued bonus shares, the company did buyback of shares, anything can happen. The problem is that in the numerator when we take profit, profit is of the entire year. We are not taking the profit of one day. The profit for the year 2019 December. Now, if I am taking number of shares in the denominator, at the beginning of 2019, the number of shares were 1 lakh. But at the end of the year, the number of shares is 1 lakh 20. If I am dividing by 1 lakh, then also it's wrong. And if I am dividing by 1 lakh 20, then also it's wrong. Reason being that the profit is earned in the entire year. So only the 1 lakh shares which was from the beginning, the money was invested from the beginning entire year. That is not the money which has given us income. If we have issued shares during the year after 6 months, then the money which we have invested in the business, that also has given us income. But that has given income only for 6 months. That has not given us income for the entire year. On the beginning share capital, on the beginning shareholders' money, we got the income generation for the entire year. We utilized that capital entire year. But the shares which we issued after the beginning of the year, after 4 months, 6 months, 8 months, we generated income on that, but not the entire year. If the shares were issued after 6 months, we generated income from that investment only for 6 months. So it is illogical that if I divide 1 lakh, I am escalating my earnings per share. And if I am dividing by 1 lakh 20, I am not doing correct because I am decollecting. Why? Because the 20,000 shares money was not used for the entire year. But in denominator, I am taking entire 20,000. But in the numerator, the profit I have generated from 20,000 shares money only for 6 months. So the accounting body made a rule that we will be calculating in the denominator number of shares weighted average. Not the beginning, not the ending, weighted average. What is weighted average? The number of shares multiplied by the weight of time. 1 lakh shares was for entire 12 months. 1 lakh into 12 by 12. But 20,000 shares were there for only 6 months. So 20,000 into 6 by 12. So weighted average number of shares 1 lakh into 12 by 12 plus 20,000 into 6 by 12. So weighted average will come 1 lakh 10,000. This 1 lakh 10,000 can be calculated in two ways. One which I said 1 lakh into 12 by 12 plus 20,000 into 6 by 12. 1 lakh plus 10,000. 1 lakh 10. The other way I can calculate 1 lakh shares was there for 6 months. 1 lakh into 6 by 12 plus 1 lakh 20,000 shares were there for next 6 months. So 1 lakh 20 into 6 by 12. Either I will do 1 lakh into 12 by 12 plus 20,000 into 6 by 12, or I will do 1 lakh into 6 by 12 plus 1 lakh 20,000 into 6 by 12. Both will give me 1 lakh 10,000. Which one is better? Which one is better? Whether 1 lakh into 12 by 12 plus 20,000 into 6 by 12 or 1 lakh into 6 by 12 plus 1 lakh 20,000 into 6 by 12. Which one is better? The second one is better from exam point of view. A reason being that you have limited time. So you don't go for single calculation during the entire year. Whenever the number of shares has changed, you go on changing the fraction. Up till 6 months, the number of shares were 1 lakh into 6 by 12. After that, the number of shares become 120 for next 6 months. So into 6 by 12. It's not that the examiner will do wrong, that why you have done 1 lakh into 12 by 12 plus 20,000 into 6 by 12. You can do, no question. But if you follow the second one, it is better. You will be able to do it faster calculations. During the year, whenever the number of shares has changed, then you need to change the weight, change the number of shares, so that you will get weighted average number of shares. And it is pretty logical, because the money realized from 20,000 shares has not given income for the entire year. The money realized from 20,000 shares has given income only for 6 months. So the number of shares would also be adjusted to calculate earnings per share. Now the new issue is of 3 kinds. One is normal issue, one is bonus issue, one is rights issue. Normal issue, what example I gave. Bonus issue, the company is giving shares to the shareholders without any consideration, free. That means it's a dividend. Dividend in cash, it is dividend in shares. Now when the company gives 20,000 bonus shares after 6 months, the company is not receiving any money from shareholder. So since there is no investment in the business, there is no increase in earnings in next 6 months, because there is no further investment. So the numerator is giving income for the entire year on say 1 lakh shares capital. It is not giving income on 20,000 shares, because that is not giving any money. The 20,000 shares are given to the shareholders free, bonus. So the accounting body says that if it is a case of bonus shares, you will consider that the bonus shares were issued from the beginning only. They are from the beginning only. You will not consider 20,000 into 6 by 12. You will consider 20,000 into 12 by 12. Because there is not increase in the investments, there is no increase in income, they will be considered from beginning. So you will divide profit by 120, not 110. But the problem is there in the current year, bonus shares is there. So in the current year, because of bonus share in the denominator, the earnings per share is going down. But in the last year, bonus shares was not there. So in the last year, the earnings per share was higher. Any layman will think that the company is not performing well. Their earnings per share has gone down as compared to last year, but which is not logical. The company has given shares. If I have 10 shares, after bonus I have 12 shares. Maybe my earnings per share is less, but the total earnings is 12 into that. And if there is no bonus shares, that total earning will be for 10 shares only. So we cannot compare the current year earnings per share with the last year earnings per share if there is a case of bonus. What we need to do? In the last year, the EPS which was calculated, we need to restate the EPS. We need to recalculate the last year EPS. Assuming that the bonus was there last year also. Assuming that the last year also 1,20,000 shares, not 1 lakh. So earlier last year we calculated EPS by dividing 1 lakh. But we calculate EPS by dividing the profit of last year by 120 again. And for comparison purpose, we will be comparing the restated EPS of last year with the current year, so that a meaningful comparison can be done. So in case of bonus, there are 2 things said by the accounting body of the world. One is bonus is not giving any income. For that reason, the bonus share will be considered as issued from the beginning of the year. And the second thing, since the bonus shares are issued in the current year, the earnings has gone down, adverse effect on earnings. You can't compare with the last year earnings when the bonus was not there, because bonus was given to the shareholder only. So last year earnings need to be restated, then only the meaningful comparison can be done. So when the bonus is there, we need to do 2 things. No weighted average, it is treated as from the beginning only. And the bonus shares will be considered in last year also to recalculate the EPS of last year, which is said as restated EPS. Everything which is said or which is discussed in the accounting standard is purely 100% logical. If we understand the logic, I don't have to do any calculation. I don't have to read anything. If I don't understand the logic, maybe I will study 50 times. Then also I will forget. After the class only I will forget. Tomorrow I will forget. But if the logic is there, then in that case there is no problem. And according to me, in every step of EPS calculation, logics are there. So I never forget. I never want to read the EPS again since my last 20-25 years. Because it's very logical. Everything is said so logical, then why I will forget? I will never. Figures will be different in every question. That's other thing. But since logic is there, that means it is pretty understood in my brain. That we want. because that does not involve anything. Now, the third thing is that the company is giving rights shares. Rights shares, the company is getting money, but the company is giving rights shares to the existing shareholders. That is because of this reason it is called rights. Rights issue means if a company is already there and the company wants to issue further shares, then first of all the company need to offer it to the existing shareholder only. If the existing shareholder will say that they will not take the shares, then only the company can give shares to the new shareholders in the market. Suppose Reliance is going for rights issue. The market price is 500. They have to say first of all to existing shareholder, you can take shares. But the existing shareholder will not buy the shares at 500. Why? Because in the market they are available at 500. I can purchase from the market. Why? I will purchase from Reliance company only. So company has to give the shares to the existing shareholders at less than the market price. What is the formula or rule? There is no rule. Company law rule are there. SEBI guidelines is there. I don't know those SEBI guidelines. I remember that when I did CA in 1998, I studied that. But now the SEBI guideline must have changed. That what is the discount you can offer on rights shares? We are talking not law. We are talking that logically the existing shareholder will take the shares when they will be getting the shares at less than 500. Suppose the company is giving them at 450. Suppose the existing shareholders are said that you can take the shares at 450 even though market price is 500. Now I am the shareholder of Reliance, but Arvinda, you are not the shareholder of Reliance. So I am getting the option, I am getting the right to purchase shares of Reliance at what I should say 450, but you are not getting. I am the shareholder for that reason. Whether I will purchase at 450 or not, that's a question mark. Somebody will say, why I will not purchase? Because when the company is offering the shares at 450, the Arvinda or anybody who is not the shareholder, they will think that why the company is giving at 450. That means the company commands a value of 450. For that reason, when the rights is announced, then the prices will increase in the market. But when the rights will come in the market, then the price will go down. Because the other shareholders who are not the shareholder of Reliance, they will consider that the value of the company should be 450. For that reason, company is giving shares at 450. Please understand, if today company will announce rights issue, Reliance, and I am having the shareholder, I am not interested in selling my existing share because my share is 500. I am getting because of that the right to purchase at 450. If I will sell my shares to Arvinda, Arvinda will get the right to purchase at 450. So I will not sell my shares. So the demand is there, supply is not there, prices will increase. Once the company announce the rights, price in the market 500, 500, 510, 520 like that. It will increase. But once the rights will come in the market, then the price will go down. Average it will be there. That's logical, rational. We can say rational market. Now, if suppose the Reliance is saying that for every share I can get one share, not that any shares. The company is saying that the existing shareholder will get one share for every 4 shares. So if I have 4 shares, the value of those 4 shares is 500 into 4, 2000. I will be able to buy one share at 450. The total value will be after giving 450. 2000 is already the value. And after giving 450, the total value will be 2450. 2450 will be the value of 5 shares. Because 4 plus 1. So the average value after rights issue, a logical, a rational person will say 2450 divided by 5 will be becoming 490. 2450 divided by 5 will be coming 490. After rights issue, the price is going to become 490. But before the company has given rights shares, the price is 500. In technical language, 500 is called come right price. Before the company given rights shares. And in technical language, 490 is called X right price. After the company has given rights shares. Now, whether actual price will be 490 or less than 490 or greater than 490, God knows. We say 490 is a theoretical X right price. Logically, rationally, this should be the X right price. But the actual price in the market may be greater than 490, less than 490, God knows. But when the company is announcing right and the price is 500 and the rights shares are given at 450, we say that the price is going to be 490. Now, we are saying that when the price is 500 and ultimately the price is going to be 490. Please understand that earlier I have 4 shares. So my wealth was 4 into 500, 2000. After rights shares, I have 5 shares. And if I consider that after rights shares, the price is 490 because that is logical. So 490 into 5 is 2450. So my total wealth after rights share is 2450. But there is no gain or loss to me. Why? Because my wealth is increasing by 450 after giving 450, not free. My wealth is increasing by 450 after giving 450, not by free. So there is no gain or loss to me if the price is 490. If the price is greater than 490, I will gain. If the price is less than 490, even after purchasing rights shares, I will lose. For that reason, I need to take a call that whether I will take rights shares or not, I have to decide. God knows what I will do. God knows whether the price will be 490, greater than 490, less than 490. But then I need to decide whether I should purchase or not. If I don't purchase, there is a direct loss because price will be 490 in place of 500. If I will purchase, there may be gain, there may be loss, there may be nothing. As a rational person, I will say that if I will purchase rights shares, there will be nothing. So karta kya na marta, marta kya na karta. I have to purchase rights shares at 450 or I will sell my right to Arvinda. I will say to Arvinda, you purchase at 450 from the market and you give me 40 rupees. I will say to Arvinda, you purchase from the market, from the company at 450 and you give me 40 because the price is going to be 490. So on my 4 shares, whatever loss I am going to suffer, 500 to 490, I am asking Arvinda, you pay me 10 into 440. So Arvinda cost is 450 plus 40, 490, and my 40 rupees loss when I am receiving from Arvinda, I am covered. This is all non-accounting area. This is just I am saying what is the logic behind rights issue. But if I am saying about accounting, then the accounting body says that rights issue involve a bonus element. Rights issue involve a bonus element. What is that bonus element? You are getting actually a shares of 490 whereas the price is 500. Ultimately you are getting the price is 500 and the price after rights issue is going to be 490. So you are getting something at 490 whose price is 500. So the accounting body says that you are not getting free. You are paying 490, then you are getting shares. But the bonus element is that 10 rupees. You are getting something of 500 at 490, so the bonus element is 10 rupees. So the accounting body says that 500 divided by 490 is a bonus element. What they want to say? If the company has 1 lakh shares at the beginning, and the company is issuing rights shares after 6 months 20,000 and the bonus element or rights element is 500 by 490. So they say that 1 lakh shares before the rights issue, that is for 6 months, the bonus element is 500 by 490. 1 lakh into 500 by 490 into 6 by 12. 1 lakh into 500 by 490 into 6 by 12. 6 months. Now after 6 months rights shares are given. Bonus element gone. After 6 months, the number of shares is 1,20,000 into 6 by 12. The bonus element will be considered in the original shares before the rights issue. The bonus is not full. You are not getting shares free. You are getting at a lesser price. That lesser price is a bonus that need to be incorporated in calculating earnings per share. The another logic for this, you should be getting 500. But you are getting 490 only in the company and that you are utilizing in generating income. Okay. So you need to consider in the denominator 490 only. Why 500? For that reason, they are increasing the number of shares so that the earnings per share will be going down. Bonus we are considering, earnings per share going down. Similarly, the rights share we are considering, earnings per share will go down. But then again, we can't compare with the last year because last year the rights was not there. So in the rights also, the last year earnings was calculated based on 1 lakh shares, but we will be revising the shares of last year 1 lakh into 500 by 490. and then again divide the profit of last year by the revised number of shares. That is called restated earnings per share of last year, so that a meaningful comparison of the current year and last year can be done. For bonus, there is no fraction. It's straight away from the beginning. For rights, you need to find out cum right price divided by X right price. I can see that the market price before rights issue divided by market price after rights issue. That is called the bonus element. And that bonus element need to be taken into consideration for calculating weighted average number of shares, for calculating EPS. And that bonus and rights fraction need to be adjusted in the last year earnings also to restate the earnings of last year to calculate the weighted average number of shares and revised EPS, which is again logical. Because if we don't do that, then the earnings per share of current year may be going down, but it is not logical. We have given the benefit to the shareholders only. So that need to be incorporated in calculating EPS. So that is treated as adjustment of bonus, adjustment of rights, or adjustment of any new issue in the denominator weighted average number of shares to calculate EPS. They have given only solved examples. If you want to do the questions which are unsolved, you can go into financial reporting, the lower level book, financial reporting FRF 7. There you will get the questions which are unsolved, because there is a topic IAS 33 EPS. Here there is no topic. It's explained as a part of ratio analysis, not an issue. An entity issued one new share for every 2 existing shares at 1.5 per share on 1st July 2018. So company is giving 1 share for every 2 shares at 1.5 each. The pre-issue market price is 3. So company is giving at 50% price. Generally that doesn't happen. Company gives shares at 20-25% discount. Not 50%, but the question is question. So they are giving at half a price. So what we can say, after rights issue, what will be the price? If the company is giving 1 share for every 2 shares, the shares is given at 1.5, but the existing price is $3. So after rights issue, what will be the price? After rights issue, what will be the price? We are saying 2 shares. So 2 into 3, 1 share at 1.5. So 2 into 3, 6 plus 1.5, 7.5 divided by 3. So it is coming 2.5. 2 shares, for existing 2 shares, I will be getting 1 share. So 2 shares value is 2 into 3, 6. 1 share value is 1.5, 7.5. 3 shares value is 7.5. So per share 2.5. So a rational logical person will say that the price will be 2.5 after rights issue. But practically it is not. The price may be greater than 2.5, less than 2.5, maybe 2.5, God knows. Rationally, logically we say that it should be 2.5. So the fraction, bonus fraction is 3 by 2.5. 3 is cum right price, 2.5 is X right price. So the bonus fraction is 3 by 2.5. 3 by 2.5 will come, I think, 1.2. 3 by 2.5 is coming 1.2. Because 2.5 into 2 is 0.5. So it is coming 1.2. So they have given the details. Profit attributable to the ordinary shareholders for the year ending 2017-18. Number of ordinary shares in issue on 31st December. Now the rights shares are issued in the current year in July 18. The year ending is December. The 31st December number of shares 12 lakh. 2018 is after rights issue. How? 8 lakh shares was there. For every 2 share, 1 right share. So 8 lakh divided by 2 into 1, 4 lakh. So after rights, it is 12 lakh. So in the current year, before July, 6 months, the number of shares were 8 lakh. And from July to December, the number of shares is 12 lakh. But the original share 8 lakh have some bonus fraction, rights fraction, which is 1.2. So the weighted average number of shares will be 8 lakh into 1.2 plus 12 lakh, 8 lakh into 1.2 into 6 by 12 plus 12 lakh into 6 by 12. 8 lakh into 1.2 will be coming 9 lakh 60. 9 lakh 60 into 6 by 12, 4 lakh 80. And 12 lakh into 6 by 12, 6 lakh. So 6 lakh and 4 lakh 80. 10 lakh 80,000 weighted average number of shares. The 2018 EPS. 5 lakh 50 divided by 10 lakh 80. 5 lakh 50 divided by 10 lakh 80 will give us EPS. How much it will come? 5 lakh 50 divided by 10 lakh 60. 10 lakh 80. Yes. 10 lakh 60 na? 1 second. 8 lakh into 1.2, 9 lakh 60 into 6 by 12, 4 lakh 80. Yes. 10 lakh 80. 5 lakh 50 by 10 lakh 80. What is the earnings per share of current year? 5 lakh 50 by 10 lakh 80. Anybody? 5 lakh 50. You take 55 by 108. The number of shares are greater. 5 lakh 50 divided by 10 lakh 80. So 55 by 108 will be in points. I think it is 0.509. 0.509 generally in exams we say 50.9 cents. 50.9 cents. Since it is less than $1, it is said as cents. It is said as 50.9 cents. Now because of the rights issue, we will restate the earnings per share of last year. The last year it was 4 lakh 60 by 8 lakh. But we will recalculate of last year. 4 lakh 60 by 9 lakh 60. Why? Because 8 lakh into 1.2, 9 lakh 60,000 shares. So 4 lakh 60 by 9 lakh 60. What is the last year EPS? Four lakh 60 by 9 lakh 60. Last year EPS 0.478. If we don't consider the effect of rights issue, then what was the earnings per share of last year? 4 lakh 60 by 8 lakh. If we don't consider the effect of rights issue in the last year, then what was the EPS last year? 4 lakh 60 divided by 8 lakh. You can see that if you don't adjust the rights issue adjustment in the last year, the earnings per share is 0.575, 57.5 cents. And in the current year, it is 50.9 cents. In the current year, it is going down. Somebody will say that very bad company, they have done the rights issue, then also they are performing bad. But that person is wrong. The interpretation is wrong. The current year, because of rights issue, the earnings per share has gone down. So we cannot compare with the current year 50.9 with the 57.5. The last year adjustment we need to do. We will assume that the bonus element, the rights issue was there last year. Then it is coming 47.8 cents. So from 47.8 cents, it is 50.9 cents. So the company's earnings per share has gone up. The company is doing well. The money which they have raised to rights issue, they are utilizing efficiently, effectively. So the earnings per share has gone up. So if we don't adjust the earnings per share of last year, then we can't compare. For comparison purpose, we need to adjust. But the last year earnings per share without rights is 57.5 cents. If I divide 57.5 cents by 1.2, how much it will come? If I divide 57.5 cents by 1.2, how much it will come? It is coming same 47.8 cents. So can we do like this? So in the books it is written that your multiplying factor, your bonus factor is 1.2. Inverse of your bonus factor is 1 by 1.2. So if last year earnings per share you multiplied by 1 by 1.2, you will get this figure. You can do 4 lakh 60 by 12, 9 lakh 60. Nobody is questioning. But the shortcut is that the last year EPS 57.5 multiplied by fraction of the bonus factor. Fraction of the inverse of the bonus factor. The bonus factor is 1.2. It is 1 by 1.2. So 57.5 into 1 by 1.2 will give you earnings per share of last year like fatafat. They are saying that The number of shares in the current year 8 lakh into 6 by 12 into 3 by 2.5 and 12 lakh into 6 by 12, 10 lakh 80,000. So the earnings per share 5 lakh 50 by 10 lakh 80, 50.9 cents. The bonus fraction is 3 by 2.5 that they have calculated come right price by X right price. They are showing the calculation, but they are doing very lengthy calculation. Total number of shares they are taking, we should take 2:1. 2 shares 2 into 3 plus 1 into 2.5 divided by 3. We can do faster. Let them do whatever. EPS in the financial statement for the last year is 57.5 cents. This is restated in the financial statement for the year ended 2018 because we cannot compare with 57.5. We need to restate. So 57.5 into 3.2.5 by 3. Or I can say 57.5 divided by 1.2. Inverse of fraction, when we multiply with the last year EPS, we get 47.9, which is last year EPS. You can do long calculation last year profit by the weighted average number of shares after rights element, or you can just inverse of the fraction, you multiply, you will get that. It's upon you what you want to do, but the calculation should be correct. Because if it is wrong, your interpretation will be wrong. Are we getting the weighted average number of shares calculation in case of bonus, in case of rights issue, in case of normal issue? Why it is done? What is the bonus fraction in case of rights? Why the bonus shares are treated from the beginning? Are we getting? Arvinda, Poonam, Sumit, Srasti. For Poonam and Sumit, it is more important because in IFRS, they can ask questions. They ask questions on EPS calculation. Which to everybody needs to do, which I say in every class. Even though you are there in the live class or you are doing recording, but when I am there, you will understand. But when you do on your own, you will not be able to do. Not you, anybody. We have to do on our own. What? The recording should be done again, first of all. After doing the recording, the questions which are done in the class should be done again. The question which I have skipped should be done. Then you can say that other areas you will be making notes, then doing other question. For questions, you can refer financial reporting F7 material. In that, there are many questions on EPS calculation. Not every question you need to do. Some question you will be doing. And along with the revision of the past, we cannot backlog the current study. Whatever we are studying now should not be backlogged. The old one, since we joined late, we can say that some backlog are there. But if we study this thing after 1 month, that is not correct. The things which we are studying now should be completed now, so that the backlog will not be compiling. The backlog which is there already because of the old, you joined late or Srasti joined today, that's okay. But whatever we are studying today should not be compiled, should be studied now only. And all of you, everybody has been given financial reporting material. So if anybody wants to test the knowledge, can do from there. There is no issue. But don't see the solution. First of all, do on your own, then see the solution. Now, in case of EPS, there is one more adjustments required, which we say as potential equity shares. Potential instruments. We can say that company issued debentures and the company has said to the debenture holders that at the time of redemption they can take shares of the company. Whether they will take shares or not, God knows. The company has given ESOP. To the employees, the company has given ESOP. The company saying that if you remain in the company for 3 years, you will be given shares of the company at lesser price. The company has issued preference shares. To the preference shareholders, they are saying that you can get the shares of the company at the time of redemption if you want. The company has issued debentures. Along with debentures, the company has given a warrant. Warrant means against the debenture, you will get your money back. The cash redemption only. But with the debenture, you are getting a document called warrant. Against that warrant, in future, maybe after 1 year, 2 year, you can get the shares of the company by paying a certain amount. So as a debenture holder, you will be getting interest, your principal back. But along with the debenture, you are given a document against which you can take shares of the company. We say that warrant and ESOP are option. When the employees are said that you can take shares of the company after 3 years, it's an option, not compulsion. When we are saying to debenture holder, that against debenture you will get interest, you will get principal back, but at the same time, in respect of debenture, we are giving them document called warrant against which they can take shares of the company by paying a certain amount in future. The amount is fixed now, the time is fixed, but whether they will take or not, God knows. In case of debenture or preference share conversion, again God knows. Whether they will take shares or they will take money, don't know. But all these are called potential equity instruments. Potential equity instruments means in future they may become shares. In case of conversion, that is conversion from preference to equity, conversion from debenture to equity, they will be converted into shares without any cash inflow, because we are going to give them shares against their dues. So there will not be any increment in the profit in future, but the number of shares will increase. Because if you invest money in business, profit will also increase. But if the preference share will be converted into shares, debentures will be converted into shares, then in that case there will not be any inflow. There will not be any increase in earnings, but the number of shares will increase in future. God knows, but maybe. But in case we are giving shares to employees as an option, some money we will be getting. We are not going to give them shares free. We are going to give them at a lesser price. Similarly, in case of warrant, some money we are going to receive. We are not going to give them the shares free. We are going to give them at a lesser price. But we understand that whether it's a free shares, you can say conversion, whether at a lesser price, the company shares will be increasing at a higher rate, but the profit will not be increasing at that rate. In case of conversion, there is no increase in profit. In case of lesser price, the profit will be increasing at a lower rate because the entire money we are not getting. Ultimately, the earnings per share will go down in future. Now, the accounts is solved on the basis of past data. That's logical. But the accounts need to give a feeling about the future of the company. That's the best important objective of financial statement. And when we know that the company has these types of potential instruments, preference share, convertible into shares, debentures, convertible into shares, ESOP already announced, warrant already given to debenture holder, that means in future the company's number of shares will be increasing at a higher rate. In future, the company's earnings per share will be going down. The companies would be communicating that to the investors, to the whole world. The accounting body realized that this is very important. So they said that in those companies where potential instruments are there, they have to calculate along with the normal EPS, which is called basic EPS, which we discussed. They need to calculate one more EPS, which is called a diluted EPS. Diluted means lower, down. The EPS on the basis of current earnings, on the basis of current weighted average number of shares, it's say 57.5 cents. But because of the potential instruments, the EPS is going to go down in future. We don't know what will be the future earnings, God knows. But if the earning which we are earning today and the same earning we will earn in future, because of the increase in the number of shares by a high fraction, the earnings per share of the company will go down in future. So the company need to report about that decrease in earnings, about diluted EPS also. We will calculate normal EPS, which is called basic EPS, which we have discussed. But if the company has potential instruments, then they need to calculate diluted EPS, one more EPS. That in future, because of these potential instruments, the company's EPS is going to be adversely affected, and it is going to be this in future that need to be calculated separately. Now, if we calculate PE ratio based on basic EPS, based on diluted EPS, it's our logic. I will say that we should be calculating on the basis of both. Price by basic EPS, price by diluted EPS, both. But the accounting body of the world says that if the potential instruments are there, the company has to calculate diluted EPS because it will be lower than your basic EPS. You need to say your EPS is going to go down in future. Take your call. The investors or anybody, take your call with this knowledge. For that reason, we need to communicate. How? Now we can't estimate if the profit in 2019 is this much. What will be the profit in 2020? God knows. So the profit will not be calculated again. The same profit which we are using for basic EPS will remain for the diluted EPS. But in the denominator, we will be increasing the number of shares. The number of shares will not be multiplied by any period because those number of shares has not converted in the current year. They will be converted maybe 1 year later, 2 years later, 5 years, 50 years, whatever, whenever. But the company has potential instruments now. If it is a case of conversion of debenture, whatever the number of shares against a debenture we are going to give. If it is a case of conversion of preference shares, whatever the number of shares we are going to give against preference share. If it is a case of warrant or ESOP, I need to calculate free number of shares. What is free number of shares? Very simple. Don't go into formula. If I am saying to my employees that we will be giving you shares after 3 years, for every employee say 100 shares, and the 10,000 employees are there. So 10,000 into 100, 10 lakh shares at 40% discount to the market price. After 3 years, whatever will be the price, we will be giving you shares at 40% discount to market price. Now, the knowledgeable persons is forecasting what is going to be the price after 3 years. Say the price is going to be after 3 years 50. So we are going to give them shares at what price? 50 into 60%, $30. But the price will be $50. So for $30 we are receiving money. But for $40 we are not receiving any money. Money for 50 minus 30, $20 we are not receiving. We are going to get how much from them? 10 lakh into 30, assuming that everybody will take share. That we need to assume. 10 lakh shares into 30 we are going to receive 3 lakh. Sorry, 10 lakh into 30 will give you 300 lakh. That 300 lakh if you receive at a normal price, you don't give shares at discounted price, you get at 50 only. Then 300 lakh divided by 50 will give you 6 lakh shares. The money which we are going to receive, 10 lakh into 30, 300 lakh. For this money, if we give shares at a normal price, not discounted price at 50, then 300 by 50 will give you 6 lakh shares. But we are giving them 10 lakh shares for that price. So how many shares we are giving them free? 4 lakh shares. We are giving for 30 lakh, 300 lakh, 10 lakh shares. But for 300 lakh at a normal price, we should be giving them 6 lakh shares. So we are giving them 4 lakh shares free. That 4 lakh shares will be added in the denominator. In case of conversion from preference share to shares, from debenture to shares, full shares. But in case of ESOP, in case of warrant, free number of shares need to be calculated. That free number of shares will be added in the denominator. And then we get the total number of shares in the denominator. The profit is same which we calculated earlier. Earnings per share will be going down. That is called diluted EPS. But one more adjustment. When the debenture will be converted into shares, there will not be any interest payment. When the debenture will be converted into shares, there will not be any interest payment. When the preference share will be converted into shares, there will not be any preference dividend payment. In the numerator profit, interest and preference dividend is already deducted. Because we are calculating profit for ordinary shareholders. After deducting interest, after deducting preference dividend. So when in the denominator we are considering that they become shares. So in the numerator the interest and preference dividend will not be there. But in the profit we have deducted interest and preference dividend. We need to add back. The profit we are taking that only which we have earned. But in the profit we are doing adjustment for interest and preference dividend, which was deducted. But when the preference share and debentures will become shares, there will not be any interest or preference dividend. So the profit will also be slightly increased. But the denominator is increasing by a huge proportion. Straight away the entire number of shares. but the numerator will be increasing by a fraction of the amount, the interest portion or the dividend portion. For that reason, the earnings per share will definitely be going down. That is treated as diluted EPS. And in case of free shares, ESOP and warrant, the numerator will not be changed because there is no interest or a dividend you have deducted. So numerator will remain same, but the free number of shares will be added in the denominator. Ultimately, we can say that the EPS will be going down. So always whenever the company has potential instruments, the denominator goes up because of the instruments which are going to become shares, and the earnings per share goes down. Every organization in the world which are listed in the stock exchange, India, US, UK, anywhere, they need to calculate diluted EPS also if the potential instruments are there. The example, C company is a listed entity. It has a reporting period of 31st December 2011. C company is a listed entity. It has a reporting period of December. An extract from the earnings per share disclosure note is provided below. The basic earnings per share, diluted earnings per share, they have given the calculation. Okay, that means we don't want to calculate. Let's see. Basic earnings per share must be calculated in accordance with IAS 33 earnings per share. This means that the EPS of one company can be easily compared to the other company. There are two companies or one company only? One company only, 2 years. The last year basic EPS and the current year basic EPS is lower. The last year diluted EPS, the current year diluted EPS is lower. On the figure wise, it is looking bad. This means that the EPS of one company can be easily compared with the other company. A company with a higher EPS figure is likely to pay higher dividends per share, more earnings, more dividend, although not necessarily in the short run. This helps investors to decide whether to buy, sell or hold the company's equities, that whether you are holding the shares for a dividend or not. Many investors look to invest in companies with a steadily increasing earnings per share. Generally, you or me, anybody wants to invest in those companies where EPS is increasing. Cottage Group year-on-year decline may cause concern. The earnings per share has gone down, both basic and diluted. Further analysis of financial statement is required to ascertain the reasons for this, that whether actually it is going down or there is something else. Of course, investors are often interested in future returns. For this reason, they may use earnings per share to calculate their ratios, such as price earning ratio. A higher price earning ratio suggests that the market is confident about the entity's future prospects. It is important to remember that the market can be wrong, as was the case with the dot-com collapse at the beginning of the 21st century. Because earlier, you must be knowing about ACCA, and you can say that there was a company in the end of 20th century. I meant to say it in the 90s. What was the name of that company? The price was in thousands. And then that company closed down. Anybody remembers? I'm forgetting the name, sorry. Not getting in, maybe I will get in my word. The companies are there whose price earning ratio was 300 times, 400 times. But once 2000 comes, all gone. So many companies closed down and all that, you can say bug. So it's not essential that every company whose P ratio is high, that means they are good. Maybe they are exceptionally high, but that exceptional high P ratio is not justified by their business or by their nature of earnings and all that. So need to check. Generally high P ratio is preferred. That is not a question, they have given explanation. I think this is the question. C company, a public limited company, is preparing its consolidated financial statement for year ended December. C company owned 75% equity shares of C company for a number of years. The following accounting issue has yet to be finalized. That means there is a parent subsidiary story. Satyam, but that was something else. Satyam too, it's very recent, 2007-8 types. It is in 2000. In 90s, I don't remember the name. There was a company whose price earning ratio was 400 times. And in 2000, that company insolvent. Gone. It was not Satyam. I don't able to remember the name. There was a company I worked, the DSQ software. In 1998, when I did CA, I worked in a company, DSQ software for 4 months. Did job. In DSQ software, the company is nowhere. But if you do Google search, you will find. I was working in a company called Hulda Properties. Hulda. Hulda Properties was, you can say, a subsidiary of DSQ, but in books you cannot say it a subsidiary. The directors are the sweeper. I was working in that company and Hulda Property just doing purchase and sale of DSQ software, nothing else. And the number of shares purchase and sale is not 100, 200. 50 lakh shares, 10 lakh shares, 20 lakh shares every day. What they were creating? They are creating demand on shares. So there was one day, I don't remember the date. I was working in Hulda Properties. In the entire company, everywhere it was communicated to everybody, not directly, indirectly, that the price was today, say 2,900 something. I think 2,930 or something. And everybody in the company knows that tomorrow the DSQ software price will be 3,200. At least 10% goes up. All the Hulda Properties employees and all that, everybody purchase the shares of DSQ software. Tomorrow the price will be 3,200, 300 more. I didn't purchase. The reason being that I didn't have money at that time. I was very much interested, but I didn't purchase because money was not there. Tomorrow the DSQ software Ghaplas came. The company was closed, from the share market delisted, and the 2,900 who has invested today fully gone. So many persons, auditors, and so many has invested, and still the directors of the company is not known where he is there. Still. So you can say that happened at that time. That my practical experience I am saying. The price is going to go up by 10-20% tomorrow. Everybody purchase the shares, but then everything end. DSQ software does not have any software, nothing. They don't have any software. It's just that type of company. It's Harshad Mehta era and there were many involved. I don't remember everything, but this I never forget. Everybody purchased the shares for 2,900 something and they are thinking tomorrow the price will be 3,200 and tomorrow the company is closed, insolvent, delisted from stock exchange. Nobody can buy sell shares. So those who have invested on one day, next day they become bankrupt. That happens. Yes. I'm talking about DSQ software in which I worked. Not in DSQ, the name of the company in which I worked, Hulda Properties. That way. Not an issue. That is not related with our discussion. I'm just saying that owned 75% of equity shares, so it is parent and subsidiary story they are saying. On 1st January 2011, 1000 C managers were granted 500 share options. That means 1000 into 500. How many shares? 5 lakh shares. These will vest on 31st December 2013 after 3 years. If the managers are still employed, if they work in the company. The fair value of one share option at the grant date was $6. That means the price at which they will be given shares and the market price, the difference between that is $6. By 31st December 2011, that is 1 year is over, 50 of these managers had left. Out of 1,050 employee left, so they will not get the shares. And another 80 were expected to leave by next 2 years. So 80 further will leave. So 50 and 80, 130 will not get the shares. The exercise price of the options is 3. The exercise price of the option is 3. Exercise price means you pay $3, you get the shares. But they are saying that fair value of the share is $6. So you will be getting discount of $3. The average price of one of the C's equity shares over the years is $10. The company's average price over the year is $10. No entries have been posted in relation to this share option scheme. What they are asking? First of all, need to read what they are asking. Explain with calculation how the above events should be corrected in the consolidated financial statement for the year ended. Discuss the impact of these corrections on basic and diluted EPS. I need to read the entire question, then only I will understand what they are asking. Freehold property, freehold land is accounted for using the revaluation model. A revaluation has taken place in the current year. However, one plot of land is still carried in C's financial statement at its purchase cost 4 million. Similar plots of land have sold for 5 million. The company follow revaluation model. When they do revaluation, they need to revalue all the property, but they have not revalued one of the property. It is still shown at that figure. On 31st December, C company made an interest-free loan of 3 million to charity and recognized this amount as financial asset. The charity will repay the money on 31st December. Market rate of interest is 5%. So we have given the loan 3 million for charity purpose. We are not going to get any interest. We are going to get our money back. But then the 5% is the interest rate in the market. So ultimately we are losing 5%. Even though you are giving interest-free loan, but you are losing 5%. So what they are saying that these three transactions explain with calculation how the above events should be corrected in consolidated financial statement for the year ended. Discuss the impact of these corrections on basic and diluted EPS. No calculations are required. Actually, we cannot do the calculations fully because full data is not given. First of all, when we calculate, when we prepare consolidated financial statement, then in consolidated financial statement in PL account, we divide the profit into two parts. Parent shareholders, NCI. The NCI profit we add to NCI. The parent shareholders we add with the money we show in the balance sheet as retained earnings. When we calculate diluted EPS, basic EPS in case of consolidated balance sheet, consolidated financials, then we consider in the numerator profit belongs to parent shareholders only, not the NCI profit. Because in the number of shares, we have our own shares, we have subsidiary share, but we are considering profit only the profit belongs to the parent shareholders. The EPS is not calculated with the entire consolidated income. The EPS is calculated on the basis of parent shareholders earnings divided by the number of shares in the balance sheet. The number of shares in the balance sheet only is the parent shareholder number of shares. Subsidiary share is already adjusted in calculating goodwill and all that. So the number of shares is same, but the numerator will be parent shareholders earnings only. We can say that when C company has 75% shares of subsidiary, then the consolidated parent shareholders earnings is own earning plus 75% of subsidiary earning divided by the parent shares will give the earnings per share. But the earnings need to be calculated correctly. In the first case, this will be adjusted in calculating diluted EPS because this is talking about shares to be given to employees when they will, after 3 years, they will work in the company at a lesser price. How many employees will be given shares? Not 1,000. We are forecasting 1,000 minus 50 minus 80. That is 870 employees. 870 into 500. These many shares we are going to give them. They are saying that the fair value of one share options at the grant date is 6. And the exercise price of the option is 3. But the average market price is 10. We are not concerned with 6. We are saying that the $10 shares, we are going to give them at $3. So we are going to receive from them 830 into 500, whatever may be the number of shares, not 8 lakh. 870 into 500 number of shares. We are going to get into 3 the money. But for that money, how many shares we should be giving? We should be giving for that money divided by 10. Because the value of share is 10. But we are going to give them shares at $3. So the money we are going to receive 870 into 500 into 3. For that money, we should be giving them shares divided by 10. But we are giving them shares 870 into 500. So the difference number of shares will become free number of shares. That free number of shares will be coming in the denominator to calculate diluted EPS. That we need to mention in the point number 1. Free number of shares calculation should be shown because that data is there. In the second case, they are saying that we are following revaluation model, but one of the land is carried in the balance sheet at purchase cost of 4 million. We don't know the revalued figure, but the revalued figure should be recorded for all the property. And on the revalued figure, depreciation should be charged. So the profit should be adjusted by the depreciation element. Similar plots of land has been sold for 5 million. The 1 million we have recorded income. But if the revaluation should have been done earlier, then the 1 million is not the current year income. From the revalued figure, it is not a gain or loss. So gain or loss also need to be adjusted. That is as per IS 16, that you cannot do revaluation for one property. You need to do the revaluation for all the assets in that category. So we have done the revaluation model, but we are not doing the revaluation of 4 million. Now the 1 million which is income, which must be considered in income. But if the revaluation would have been done, that is treated as revaluation gain. And the revaluation is gain is coming under PL account, under other comprehensive income. That does not come in PL account. So 1 million they have considered gain in profit, but that should be reduced. For calculating basic EPS, diluted EPS, both way it will be adjusted. On 31st December, Crack made an interest-free loan of 3 million. Now, when we give loan, maybe interest-free, we need to record the loan at fair value. We are going to receive 3 million on 31st December 2014 after 3 years. So we will calculate present value of 3 million. That will be treated as a loan amount. And on that, we will calculate interest, which we are not receiving. That will be treated as a loss. So your income statement need to be adjusted by the 5% which you are not getting. Because that's the logical adjustment. The financial instrument says that. So all these three adjustments will adjust your profit. The first one will only affect diluted EPS. The second and third will affect your basic EPS and diluted EPS both. Then the basic and diluted EPS will be calculated, and then the meaningful comparison can be done. Otherwise, there is no meaning of calculating basic and diluted EPS and doing the comparison. What they have written, I also need to check. This is an equity settled. A remuneration expense would be recognized in PL for the year. This should be based on the fair value of the option. Remuneration expense in PL based on fair value of option $6. The other side of the arrangement is 1000 minus 50 minus 80, 500 into 6 into 1 by 3. The expense in the current year. So the profit will go down by 0.9 million. That I have not said. So I will not be getting full marks because I have not said the expense relating to ESOP. This adjustment reduce the profit attributable to ordinary shareholders by 0.9 million, will reduce basic EPS. The share option represents a commitment to issue equity shares in the future at an amount that is below the average share price. These are therefore a diluted instrument which will cause a further reduction, but they have not shown the calculation. Here we can see that I am saying more extra, that the number of shares is in whatever, into 3 we are going to get, but the share value is into 10. So you can say that when you divide by 10, you get number of shares which should be given, but you are giving more number of shares, free number of shares. That can also be calculated. In accordance with IFRS 13 fair value measurement, the selling price of similar plots of land would constitute a level 2 input. Level 1 means same assets market value. Level 2 means some different assets market value. It is unlikely that the level 1 input exists. However, C company assess whether adjustments are required in 5 million price into account. Assuming no adjustment are required for valuation, the land should be revalued to 5 million. So 1 million should be going to other comprehensive income. But we have not done that in the statement of other. This gain should be presented as an item, not reclassification to PL. Because if the land is sold out, then it will be revaluation to retained earning, not going into PL account. The adjustment has no impact on profit. So no impact on profit will reduce EPS. The loan is a financial asset. It gives a contractual right. The financial asset should be initially recognized at fair value. 3 million does not represent fair value. The present value of this is 2.6 million. So 2.6 million is the fair value. 0.6 million is the loss we need to record in the PL account. That will reduce the earnings. That will reduce the earnings per share. Basic and diluted EPS per share are calculated based on profit attributable to ordinary shareholder. As such, these ratios will deteriorate once the error is rectified. That is, all these errors when rectified, the earnings will go down and the profit will go down and the earnings per share will go down. That they are saying. It's not an adjustment which I will say that they ask in SBR exam. For SBR, it is slightly lower level. For IFRS, it is logical. For SBR, they will be going at a different high level than what they have said here. For SBR exam, they go into maybe it is correct, but still the presentation is adequate or not. whether the company should be going for additional performance measures or not, whether it is ethical, whether it is professionalism or not, that they see. You can say that when you write your answer, or if you don't remember, you will be going into IS 16, property, plant and equipment. You will be going into financial instrument, reading that, then writing the answer, then only see what they have written. Not in this question, everywhere. And there is no limit for this chapter, which IS, IFRS they will go. Every IS, IFRS. If our knowledge is there, we can do. Many times, or I will say sometimes, the student says that, sir, why you are not writing? Believe me, whenever I found that something which need to be written, I definitely write. In these questions, why I am not writing? Because the basic EPS weighted average calculations is pretty simple. It's just that maybe we are getting, but we are forgetting also. We need to do the working on our own only. There is no benefit by that. Because we need to understand that these are very basic things that they are covering. They will be going at advanced level. So sometimes when I found that, like I solve question of cash flow statement, consolidation, some questions I am discussing, because we are not studying for, you can say 10, 12 hours. We are studying around 80, 90 hours for a subject to understand. And that also some questions I do, some I don't do, some I write in that way. But if you follow my instructions, you will not be feeling pain that I am not writing. Because writing the theory or doing every question is not possible. When we are discussing, I am discussing, we are asking questions, then again I am reading the solutions, what they have done, and then I am again asking, is there any doubt? Then the same thing need to be done by you on your own. Then only you get conformity. That always happens, that always I instruct. Sometimes the student says that, sir, ye likhne se acha hota. But everything if we write, we will not be able to complete even in 200 hours everything. We are discussing everything at length so that you can understand, but then you need to practice. Then only you will get that. I think that further we should be doing in the next class, because there are non-financial measures, then there are integrated reporting, which we should be doing in the next class, which are more theoretical part, but still we have to do in the next class. Okay. Revise the stuff which we discussed in the current class. That's a request to all of you. Whether your backlogs are there, immaterial. Don't keep it this backlog. Okay. Leaving for all of you. Thank you. Take care. Tada.